Good morning and welcome to our latest on the road session. I've got a fantastic session for you today. I'm just going to run through a quick platform update in terms of what we've been getting up to at AJ Bell. We've then got our investment director, Russ Mould, who's going to be going through a review of the markets in terms of what's going on. We've then got our special guests from Canada Life. We've got Julia Peake, who's going to be looking at on and offshore bonds, just in the area of the various allowances that have been squeezed by HMRC, so are these going to be looking a bit more attractive? We've got Ryan Hughes, who'll be looking at investment bonds. So last year was a pretty terrible year for bonds. Is 2023 the year that might see bonds coming back in terms of something that you might want to look at for your clients? And then to finish this session off, we've got Lisa Webster, who's going to be having a quick HMRC and FCA update, what the various bodies are looking at. We'll also finish off in terms of a bit of a speculation in terms of what some various think tanks have been looking at for the pensions industry. So be about two plus hours. Hopefully have a great session. And we've had about 400 people through this as we've been up and down the country. So just be great to run it for you over the internet as well. Thanks. Okay, we're going to jump straight into our business and platform update here. Simple job for me, so just going to run through why you might want to consider AJ Bell for your clients, what wrapper options we can provide them, what investment options sit within those wrappers, a quick overview of our investments arm, AJ Bell Investments, again a quick run through of what we've been working on in terms of platform development, and just what support you can expect from AJ Bell. So first slide, the easy job. So why AJ Bell? A great Northern success story, founded by Andy Bell and Nicholas Littlefair, with £10,000 of personal loans. As you can see now, we've grown to a business that's got north of 1,000 employees, north of £70 billion under administration, and just under 450,000 clients trusting us with their money. Again, we like to keep things very clear. So our motto is that we help people to invest. What that's led to is, you can see there the metrics for the business for the year ending FY22, and what we have seen is an increase in revenue, customers, and profit. Unfortunately, the markets haven't been kind to us. We've seen a little bit of a dip in terms of assets under administration. I'm sure we've had similar stories for advisors as well. Hopefully, we'll see a recovery over the course of the year. But for us, the important metric there is customers. As long as we're starting to see customers increase on the platform, we've got a business model that is exceptionally clean and really profitable, and again we'll just hopefully see assets come off the back of that. If we come out a little bit and just see how that's looked since FY16, what we've had is a real linear increase in assets and customers. This is all organic, so we haven't bought any business in. This is all from advisors and retail clients such as yourselves, which has seen that those assets increase organically over the years. Again, we like to think that we do things well, and we do the simple things. So what that has led to is a number of industry awards there. Not something we get out of bed for, but it's great to see that the hard work has led to some recognition from industry bodies. In terms of wrapper options, we appreciate that you look at clients not as an individual. You're probably looking at family groups, so you really want to see the savings pockets that are available for those individuals and families. So what we've got in our family savings tree is, at the top we've got our pensions. We've got two types of pension. We've got our SIP and our retirement investment account, the RIA there. We've got an ISA, general investment account. We then start moving down the generations. We've got a Bear Trust, junior SIP and junior ISAs for dropping cash down through the generations. We've also got designated accounts and charity and limited company accounts, and then offshore bonds, which we're going to be learning a bit more on later in the session. So hopefully, looking at that intergenerational savings tree there, you can see that we've got the vast majority of savings buckets that really you should need to look at families. So we don't want you to have to pigeonhole AJ Bell for individuals, but we'd like you to be able to consider what we offer for the entire family. Where can you invest within those buckets? On our funds and shares platform, we've got the ability to run managed portfolios from AJ Bell Investments, which again we'll run through shortly, and a range of third-party DFMs, which we'll have a look at later in the session. We also run a range of multi-asset funds, again, which we'll have a look at slightly later, and a distinct retirement portfolio service. So if you've yet to finalise your centralised retirement proposition, we're happy to have a conversation with you on that side of things as well. Investment partners, so if you're looking for bespoke investment management, if you want discretionary funds, we've got links with a range of DFMs, around 20, that can manage your client's money directly on the platform. And we've also got our off-panel option, which is where you would have those trusted investment plans, external cash, fixed rate annuities, dropping money into bank accounts. So it really is a fully open architecture product where you can invest in a number of investment options. What can you invest on our platform? So you can see there we've got these are the asset classes that you can access via our funds and shares platforms. You've got unit trust, STOICs, ETFs, ETCs, investment trusts, pretty much every option, which is why advisors love the platform, because it gives you freedom in terms of how you can build your model portfolios. It's also really flexible as well for DFMs that are running managed portfolios, because it means they've got every building block available. There's no compromise in terms of how they run their MPS. From a cost perspective, within the main pension, ISA and GIA, you can access our funds and shares platform at 20 basis points. That does tier down through 15, 10, and eventually caps out when clients hit 2 million. For the retirement investment account, which is aimed at your small to medium-sized clients, we do remove a lot of the pounds and pence fees, so the custody fee then does increase slightly to 25 basis points. It still offers excellent value for money for those smaller cases. In terms of the range of DFMs, we've got probably what you'd expect to see on the platform, so you can be high street DFMs and a few diversifiers in there. We are actively speaking to additional discretionary fund managers to increase that panel. That will be done on a demand-led basis. So if there are DFMs that aren't on the list that you'd like to see there, come and speak to me or the team, and we'll make sure that we engage with those just to try and increase that panel as and where the demand exists. Our in-house options, so AJ Bell Investments, we've been running for a number of years now. We've increased through that £3 billion mark. So we've seen a fantastic flow into the propositions, but a bit of a busy slide this one, but just to run you through the basics. So across the top, we've got how we reference our managed portfolios, so 1 through to 6, the names that we give the funds, so cautious through to global growth, and how those map across the various risk profiling tools. So if we start at MPS 3 or balanced, you can then go down and see the options that we've got. So we've got the multi-asset fund, we've got a passive version of our MPS, we've got an active version of our MPS, we've got a blended active, and we've also got a responsible range. So effectively, you can risk profile your client, and then you just follow that down and see what options are available. In terms of consistency, we charge 15 basis points, whether that is an OIC, whether that's a managed portfolio, whether it's active or passive. So you always know what the pay away is to AJ Bell. Any saving that we can generate on top of that goes directly back to the client. So the top line for the funds you can see there is 31 across the board. Now we'd like that to start with a 2. So the kind of task within the business is to see if we can get that cost down to the 20s, around the 30s, and every saving that we make will go directly back to your clients. If we unwrapped our balance fund, this is what it looks like inside. So as you can see, it's completely unfettered. We'll use funds from providers in the right marketplace. If we want a kind of a FTSE tracker, we can use any provider out there. Again, if we want to invest in Asia, we can use providers out there. So it really gives us the ability to hone in on exactly the areas that we want to invest without being restricted to a specific provider's products. Performance, nice and simple. I know that Ryan will be going through this in a bit more detail, but we've got kind of first quartile performance across 1 year, 3 year, 5 year, across the range. MPS 6 has yet to hit that 5-year mark, so we don't have the 5-year numbers, but no, performance has been excellent over the short and medium and long term. And again, Ryan will be going through some of the drivers for the performance that we've got there. If you really want the detail, these are the slides that show you the 1 year, 3 year, 2 year, etc. performance on all the range of solutions. I'll not go through these in any detail. They're really just for the slide. So what have we been working on in terms of making improvements to the platform? Big piece of work for us is onboarding. So what we are doing at the minute is wrapping a number of processes that you need to go through to add a client onto the platform, including loading the client to the website, generating the illustration, analysing portfolios for costs and charges. At the minute, they potentially can be 3 distinct jobs. Now we'll roll those into one journey. So if you give us a piece of information about a client, we'll use that to generate the illustration, calculate any transfers, pull charges across, etc. So you'll never need to give us the same information twice, and multiple people can access this journey through the website. So if somebody's on holiday, if the way that you work internally is that somebody might start the task off and somebody might finish it towards the end, then multiple people will be able to do that. So the team are well underway with this, and hopefully we'll start to see that come through onto the platform hopefully this summer. Other developments, we're starting to move people over to version 2 of our website. Some of you may be there at the minute, others will be moved over shortly. What that means is we can start to reduce the number of websites that you operate off. We're replacing effectively the old admin site and funds and share site with one consolidated website, which is version 2, and you'll then start to be moved across over the coming months. One-off investment model, so if you've got a client that's already invested and maybe has received some tax relief or made a large contribution, just the ability to very simply put that payment into a model portfolio without having to rebalance and disturb the existing assets. Reserve cash, if you want to hold some money back for charges, a one-off withdrawal, anything like that, the ability to reserve a bit of cash and hold that separately from your model. Cash nudges for ICGIA withdrawals. If you've got clients taking money out, we need to make sure that there's going to be nothing disturbs that payment. So in advance of the payroll run, we'll send you an email should any client be a little bit short on cash. Something we're doing on SIP at the minute, so just extending that to make sure your clients always get paid. And tiered advisor charging, so giving you the ability, again, in the consumer duty world, maybe to start tiering down your charges for larger clients, minimums, maximums, just a number of options that will be enhancing the advisor charge on platform. We are big on support, so we are still out there, talking to advisors, both in your offices and also over the phones and Teams and Zoom meetings. So the layer of support that you'll get is each region has a team of 3. So there's myself, which is the business development manager, and there's Rob and Harry that assist me primarily at the office, but again, we like to get them out as and when we can to meet the advisors that we deal with. We've got Danny Arthurs, who is the head of sales for the North of England. And we've also got Andy Adshead, who's the investment business development manager. So if you like what we do on the investment side of things, but haven't necessarily bought into the platform, Andy's happy to come and talk to you about how you can access our investment solutions on other people's platforms, or indeed, if you just want to chat about how our investments work on our platform, myself and Andy are happy to come out and talk to you on both of those subjects. If you are unhappy with your current platform and you're looking to move your clients across wholesale, then we'll happily build a project using our platform support team. We've moved billions of pounds of assets from other platforms, probably covering the vast majority of platforms in the marketplace. So we'll be happy to work with you to build a project to move those assets across and really give you a bit of advice from our experience how best to approach something like that. And we've also appointed a platform adoption consultant. They'll be responsible for helping you train your staff as well. So not only do we help you move the assets across, we'll also offer an in-house training to make sure that everyone at your end is comfortable with how our platform functions, so that when the assets do land, everyone's up to speed. Ryan Hughes, we'll be hearing from later on. So Ryan is our head of investment partnerships. A lot of people have bought into our managed portfolios, but where we've seen a real interest is possibly tilting those or bespoking them. So if you've got budgets, or you want an active passive split, or you want slightly different tilts, but you like the way that we see the world and you bought into AJ Bell as an asset manager, we'd be happy to come out and talk to you about what can we do to possibly tilt our portfolios so that they suit what you're trying to do and suit your client bank. Fully branded, and all the supporting literature will carry your branding, and you'll also have the ability to sit with us on a quarterly investment forum just to go through how the portfolios are working and a full overview in terms of any changes that we might be considering. And finally, we also maintain a due diligence hub, which has got all the kind of internal and external marketing literature. The most recent one to go on there is the Finalytic report. If you've ever seen any of Abraham Mokasunya's literature before, he effectively looks at the bottom line for platforms. So let's step away from the business as a whole. Let's look at the investment platform, and is that business generating sufficient cash to cover its overhead? So in terms of the platform, is that a viable business? There are 80% of the profits have been generated by 5 platforms, so there's not a huge amount to go around with the other kind of 18 odd. 20% asset left, 20% profit left after that. Again, they've been looking at us for now 8 years, and we've had an excellent rating for profitability, and also if you are moving into that consumer duty world, it means that if you are using AJ Bell, you can be confident that we are a viable business that is financially secure, that is committed to the UK platform market. That's it from me. I mean, any questions or comments or feedback? We do have a chat function available as part of the session, so if you've got any questions for me or for the team, please feel free to add them to the chat function. Same applies to the sessions later in the day. We've got Canada Life and the other speakers from AJ Bell. Please feel free to add any questions or any feedback needed to the chat function at the end. You'll also have some feedback after the end of the session. If you make sure you complete that, send that back to us, you'll get a copy of the slides, and you'll also get a CPD certificate for the time that you spent with us today. But thank you very much. So next up is our investment director, Russ Mould. He'll be dusting his crystal ball off just to look at what portfolios might be doing over the coming year, and just a roundup of the investment market. So I will pass you over to Russ.
Hello, I'm Ross Mould, AJ Bell's investment director, and in this short 15 to 20 minute presentation, we're going to look at pauses, pivots, and policy pickles, and the implications of all three for financial markets in 2023 and beyond. As I'm sure you're aware, in the past few days of the farrago involving Silicon Valley Bank, well, that's all related to this, and that's not me banging my own trumpet, but it is the sort of thing that we've been worrying about possibly coming out of the undergrowth for some time. So these are the topics that are going to very quickly whiz through. 2022, we'll park that as quickly as we can. 2023, then we'll look at what's changed, the biggest issue of all, how you can track the implications of that biggest issue and what's developing, and finally, perhaps a few hopefully helpful conclusions. So 2022, well, again, the less said, the better. Whether it was war, whether it was climate change, whether it was political chaos, labour unrest, rising interest rates, or good old-fashioned allegations of fraud in the bottom right-hand corner with Sam Bankman-Fried, 2022 was not necessarily a year that will live in the memory for all of the right reasons. And from an investment point of view, unless you and your clients were long commodities, it was frankly really pretty tough sledding. As we can see from this chart here, looking at capital return in local currency terms, it was commodities first, the rest nowhere. Natural gas, oil, commodities, the Bloomberg Index in general, and gold all held their own pretty much. Corporate bonds, high yield bonds, and government bonds struggled. Equities struggled even more, and Bitcoin was, well, almost fell off the chart here on the right hand side as risk appetite ebbed in the face of a process of price discovery in terms of what indeed now is the correct cost of money, given that it certainly wasn't zero, which is where central banks have been holding it for some time. And looking at just zooming in into equities more specifically, there were some gainers. They were hard to find. Brazil, India, and the much maligned FTSE 100 managed to stay in positive territory in local currency terms. The biggest fallers were some of the previous lockdown darlings, rather like Bitcoin, with Nasdaq there, a very heavy faller on the right-hand side, and Europe struggling under the weight of higher energy prices there in the middle. However, until Silicon Valley Bank, at least, 2023 had a bit of a better feel for it. And intriguingly, everything that had worked so well in 2022 would stop working, and everything that had gone wrong in 2022 started working again, or at least to some degree in a big flip round of sentiment. So Bitcoin's had a great run. Equities had managed a bit of a gain. You'd seen, all right, gold sort of holding its ground in the middle, but commodities had actually been the underperformers. And in equity terms, last year's winners, Brazil and India, now this year's losers over to the right-hand side. And last year's big losers, things like America, for example, and to a degree the Europeans, they're some of the leading gains, with China noticeable there in the middle as it begins to unfurl after a lengthy period of lockdown. Hopes there for improved economic activity, giving the Shanghai Composite a long-awaited lift, and the same to a degree for Hong Kong's Hang Seng Index. So what's changed? Well, first of all, let's face it, valuations got cheaper. So, there were heavy falls, particularly from sort of February to October last year. There was then a big rally at the end of the year, but in the end, valuations got cheaper. And I think it was therefore tempting to argue or start to wonder whether, to some degree at least, a recession had been priced in. We got a break in the fact that oil and gas prices started going up, stopped going up and started going down. That has helped take some of the sting out of inflation. And we've actually had some slightly more optimistic commentary on economic growth, both from talking heads at Davos and central banks, but also some of the macroeconomic statistics actually haven't looked too bad. And central banks, while at the same time acknowledging perhaps the economy's been a bit stronger than thought, you have seen a deceleration in the pace of rate rises. The Federal Reserve's last rate rise was just a quarter point. It had been a half before that, and the previous 3 or 4 meetings had all been 3/4 point increases. So that's sort of allowed markets since October to think, okay, maybe we're through the worst in inflation. Maybe the rate will begin to decelerate. Okay, maybe we're going to get a soft landing, or in some cases, some people have even been arguing for no landing at all, and we'd actually avoid a recession altogether. And yet, despite that, markets are still thinking, okay, we'll get a cooling inflation, we'll get an economy that hangs in there but isn't clearly going gangbusters, and that might allow central banks to complete a fabulous hat trick here and actually put in a peak in interest rates and even start to cut them. So that was the treble that was hoped for, the hat trick that was hoped for, that helped spark the rally from October. Deceleration in inflation, no landing, or certainly a soft one, and a peak in interest rates. And markets understandably are praying for a pause and a pivot in monetary policy, because we got 367 interest rate increases in 2022 against just 18 cuts. We've had something like another 40 so far this year, according to cbrates.com, against just a handful of cuts. And the cuts have come from those who've been genuinely struggling. Turkey because of the earthquake, and also it's got some unusual political situation with a presidential election this year. China because of lockdowns. Russia because of its fall from favour with the international community after the war on Ukraine. And some of its satellite states as well have been leading cutters, but they're generally speaking not countries that will be bothering you or your clients particularly. So markets clearly feed off cheap money, they love cheap money, and they're praying for its return. And we can see here why. This is the bars are the aggregate balance sheets in dollars of the big 5 central banks who've been most active users of quantitative easing: Bank of England, Bank of Japan, European Central Bank, Swiss National Bank, and the US Federal Reserve. And as you can see, their balance sheets have broadly gone up by 60% since the start of the pandemic. And since the great financial crisis, they've more or less quintupled. But as we can also see here, the rate of growth has begun to decelerate. And as the Fed, the European Central Bank, and the Bank of England have begun to embrace quantitative tightening to various degrees and try and withdraw some of that stimulus, we've actually seen the balance sheet start to shrink. Now, it therefore may or may not be a coincidence that is why we've seen greater volatility in some equity indices over the last 18 months. This is just looking at the FTSE All World Index against that aggregate central bank balance sheet. You could argue there's a bit of a fit there, whether we may need to look at the debate separately of correlation or causation, but nevertheless, it does seem to be an intriguing coincidence. And again, it wouldn't be a greatest bit of surprise if we were to see a little bit more volatility going forwards if central banks stay the course. And I guess that's one of the key questions now in the wake of Silicon Valley Bank. So what are the cases for and against a pause or a pivot, or indeed in favour of further interest rate increases? Well, in terms of further interest rate increases, why would central banks look to further tighten policy after what may well be the fastest round of rate increases ever? Well, China, the world's second biggest economy, is reopening. That it could start to gobble up, considerable quantities of raw materials, which may be self-inflationary. You can argue that deglobalization is inflationary. If we are looking to indeed employ more people in Wolverhampton or Wisconsin rather than Vietnam, with the best will in the world, those British and American workers will be more expensive. So the goods and services they provide will be more expensive. Although, again, the employment benefits you would like to think would be considerable. It's easy to make a case for energy prices being underpinned here. Yes, natural gas has come down a long way, but oil has held firm at around $80 a barrel. OPEC's got a lot to do with that. But also, if we do avoid a deep recession, then that should be pretty helpful for energy demand. Energy demand is still growing. At the moment, renewable energy isn't really suitable for base load requirements. It can be a little bit variable. And our addiction to hydrocarbons could be hard to kick, and that could be a problem, because in the end, we've been, for good environmental reasons, telling oil companies not to knock holes in the Earth's crust, so they haven't been doing so. So supply hasn't been growing. Demand certainly has been, and it is indeed possible, as China reopens, that we get a little bit of a squeeze in oil prices, though intriguingly, it's not happened yet. Labour, I put there, strikes. We've seen some whacking wage increases in Germany, Japan, and we've seen some in the UK as well. Wage growth is still running at sort of 5 to 6% overall, higher for the private sector, I admit, rather than the public sector. And war generally is inherently inflationary. It fractures supply chains. It forces people to even redeploy industry in great cases. It can lead people to go off to war and shrink the labour force in extreme examples. Hopefully none of those bad things will come to pass. But generally speaking, war is inflationary. What would give the central banks a chance to pause on interest rate increases or pivot? Well, government austerity, fiscal probity is in theory going to slow economies down, and that may take some of the steam out of things. A recession certainly you would expect, as it would be knocking consumer and corporate investment and confidence, and therefore spending. A mild winter has been extremely helpful. If you could just look out of the window now, it's not too bad here in Brighton today. And that would certainly, again, take some of the heat out of energy prices, and has done so. And Europe's also done a good job of establishing storage, and it's also done a particularly good job of cutting its consumption. Politics. This is a tricky one, and we all know central banks are independent, even if their chairs are political appointees. And what I would say here is that if you're a politician, there's inflation out there, you're going to be unpopular, of course, because people will be frustrated because they're worse off. But if they lose their job, they're an awful lot worse off still. And so therefore, from a politician's point of view, unemployment is the bigger evil of the two. So if you had to take your chances with one, they'll probably take their chances with inflation. And then debt. This is a big issue, and we just discovered this in a microcosm with Silicon Valley Bank. Higher interest rates put the pressure on corporations and consumers. Silicon Valley Bank's customers were burning cash. They needed liquidity. They couldn't float because stock markets were largely shut to them. They began to draw down their money from SVB. SVB didn't have the liquidity to cover that, and that's where the run on the bank started, and things began to spiral from there. So debt is inherently deflationary, disinflationary, and central banks will want to try and keep a lid on the cost of servicing it, because otherwise that will create some severe problems indeed, potentially. And this is, I would argue, the biggest issue of all of this, still lurking in the background. The grey line here is the total issuance in aggregate of total US debt securities, or total outstanding at any given time. And as you can see, since Nixon took America off the gold standard in 1972, it's basically gone up in a straight line at varying rates of speed. The only time it shrank very briefly, where that circle is, that's the great financial crisis. So that tiny, tiny, tiny reduction in global indebtedness contributed to a heart attack from which the global economy really found it pretty hard to recover. Do you really think that grey line is going to start coming down? No. So that, I would suspect, in the end, will put a cap on interest rates at some stage. The Fed still hasn't, no central bank that I'm aware of, certainly in the West of the majors, has got interest rates back to where they were before great financial crisis, because the increased indebtedness in the interim means that the impact on the economy is huge. Mr. Sunak has said, 1 point on gilt rates is £25 billion of interest. In the US, it's there's a similar calculation here with America's $31 trillion of debt. America's tax income is about $3 trillion a year. There's already 700 or 800 billion of that going on tax on interest servicing, and that's really before interest rates have started going up. The UK has 850 billion or so in tax receipts. Already it's paying about 80 billion in interest. That's not a healthy situation. And if rates go up much further, and also once they start rolling over debt at high rates, that is really, really, really going to put the squeeze on. So this is the biggest issue of all. It probably does put a cap on interest rates at some stage, even if right now central banks are espousing their inflation busting virtues. And why does this matter? Well, in the end, the hit to economic activity would be potentially substantial as government interest bills rise, but also we're talking about the price of money, which has been zero effectively for 10 or 15 years, and that's why people have done dumb things with it, as Silicon Valley Bank has proven, taking on substantial amounts of risk in terms of the customers, ending up with a mismatch between assets and liabilities, not managing its liquidity properly because it never thought there would be a possibility of of rate rises or a serious accident. So when money is cheap, people do daft things with it. Now, when money has a cost, they may have to treat it with more respect. And that's why we've seen corrections in things like monkey JPEGs, Bitcoin, meme stocks, and some of the more speculative areas, because there's an opportunity cost now to doing things with silly things with money. So this is why this really, really matters for two reasons. One, the cost of debt, and two, the benchmark of which all assets are relatively priced. And we can see here's the US 10-year Treasury yield against the FTSE All World. That sharp run up there in bond yields, it's definitely had an impact, you could argue, over the FTSE All World. So what do we do? How do we track this? Well, what's uncanny is that if you look at the UK 2-year gilt in the top left-hand corner and the top half, and the US 2-year yield on the Treasuries in the bottom half, they generally move 6 to 9 months before their respective central banks do. Markets can be smart; they're not always right, but their views must be respected. Now, clearly, it's therefore tempting to argue, well, you could do away with the Fed and the Bank of England altogether and save ourselves some taxpayers' money. That isn't viable, because there's bound to be some toe-ragging investment bank who will gerrymander and jig and fiddle about with the 2-year yield, just as there are allegations that people did that with LIBOR. So we've probably stuck with the central bankers, well-intended, smart, but ultimately human, and therefore ultimately prone to error. But it's probably better than having somebody intentionally rigging something. But keep a look on the 2-year yields, because they will give you a much better feel ultimately than the central bank doublespeak as to where rates are going from here. And right now, they're actually hanging in a little bit below where rates actually are officially. So the bond market is kind of calling the central bankers bluff. They're talking hard on inflation, but the bond market isn't convinced. And if you look at the US yield curve, where normally the 10-year yield is higher than the 2-year yield because of the extra risk, and therefore investors demand extra compensation and extra yield to compensate for that time element, it's at its most inverted since 1980-81, when the US suffered 2 deep recessions in pretty quick territory. So the bond market is convinced there's a recession coming. The equity markets have convinced themselves there's going to be a soft landing or no recession at all, or at least until they did recently. So you would think on balance, one of them is going to be wrong. Now, finally, this is perhaps the ultimate test case for what we're talking about here in terms of debt. The Bank of Japan has been running quantitative easing since the early 1990s, and a zero interest rate policy likewise. So it is the daddy, as it were. It's the longest standing user of these unorthodox policy tools. Every time it tried to withdraw them, either the economy's rolled over or inflation has popped up a little, and inflation has only popped up briefly. So it's never really been able to sustainably extract itself or extricate itself from those policies, and it's having a devil of a job doing it now. In fact, as you can see here, the yen began to collapse late last year. So as the central bank continued to print money to buy bonds to suppress the interest rates, it had to make a choice: keep on printing and crush the currency, or stop printing, support the currency, but then let bond yields rise. And the Bank of Japan blinked. The bond vigilantes had their wicked way with the Bank of Japan for the first time, probably since the 1980s. The Bank of Japan raised its 10-year JGB yield ceiling from 0.2 to 0.5%, and it went there in an instant, and battle lines are now drawn again. We have a new bank coming in. He's got his hands full. If Japan starts to withdraw quantitative easing, you would expect bond yields to rise, which would be very bad for the Japanese economy. If it keeps on printing, the Japanese yen could come under further pressure, and that's inflationary. Rock, hard place is a phrase that springs to mind. And Western central banks will be watching this with extreme interest, because they might find themselves in a similar pickle. So, conclusions. Markets are still trying to work out whether we've got inflation, stagflation, or deflation coming. Right now, they've taken a benign view of the world, even though we've just had the most bizarre 2 or 3 years, enormous amounts of fiscal and monetary stimulus. They've gone for a painful Goldilocks exit from this, of gentle deceleration in inflation, no hard landing, a nice soft landing, and a pivot in interest rates. What if it happens? Fantastic. Everybody will be extremely pleased. But that's kind of assuming that we're returning to the time that we've had for the last 20 or 30 years, and that just feels perhaps a little bit too convenient. Debt is certainly boxing in central banks, and because they can only take money so far, cost of money so far, but nevertheless, there is a suspicion that they've now got a very, very difficult job taking us exactly between inflation on one hand and recession on the other. And any diversion from that, well, you're likely to see volatility in asset prices of the type that we've seen recently. It may just be that we are seeing an end to a 40-year era of cheap capital, cheap goods, cheap labor, and cheap services, cheap energy. Capital had its wicked way with labor for 40 years. Labor had its wicked way with capital for 40 years before that. You do get these occasional changes in cycles. I'm reluctant to say it's different this time, because you're normally wrong when you do, but maybe we are on the cusp of a major change. And if that's the case, then what's worked asset-wise for the last 20 or 30 years, long duration assets like bonds, like tech stocks, biotech, might not work as well if that's the case. And shorter duration cyclical value assets and hard assets rather than paper assets might be the solution if we are indeed seeing that sea change. Now, how can you judge that? Well, we won't worry too much about gold because it'll upset Kevin Duran, our head of investments. But this is the chart on the top, looks at the S&P 500 against the Bloomberg Commodity Index. And if the chart's going up, then commodities are outperforming. If the chart's going down, then equities are outperforming. Commodities are about as cheap relative to equities as they've ever been. And they went up pretty strongly when there was a sense that central banks were losing control in the early 2000s. And again, gold is just as cheap relative to the S&P 500. So if the era of cheap money, cheap debt, cheap energy, cheap goods, cheap labor is over, then you might perhaps expect commodities to start to show a little bit of a wiggle on, if history's any guide. If we go back to Goldilocks in the 2010s, low rates, low inflation, low growth, sludge, sure, long duration in excelsis, but it may be, just maybe, we're on a bit at the cusp of a little bit of a change, and this chart will hopefully help you spot it if so. So thank you very much for your time, everybody. I greatly appreciate it. And hopefully we look forward to, we'll be able to see each other in person again on another On the Road session very, very soon. Thank you.
Coming up now from our special guest at Canada Life is sales technical specialist Julia Peake. Julie will be looking at onshore and offshore bonds and just whether they are becoming a little bit more attractive with the squeeze on onshore saving rates. So I will hand you over now to Julia.
Welcome to today's webinar. My name is Julia Peake. I'm one of the Canada Life technical team, and what we'll be discussing today is tax planning with investment bonds post the autumn statement. So your learning objectives for today: by the end of this session, you'll be able to comprehend the changes of the capital gains tax and dividend allowance in light of what was announced in the autumn statement, and how this relates to fulfilling your consumer duty requirements. We'll also be looking at some features and benefits of investment bonds and why that might be suitable for certain types of clients. And then just to conclude, we'll look at some other factors that we might want to consider when we're building a holistic financial plan. So to kick off, let's start with capital gains tax. We know that when new tax year rolls around, that the capital gains tax exemption is actually going to drop. Currently, it's £12,300 for tax year 22-23, but that's reducing down to £6,000 by tax year 23-24, and then down to £3,000 by tax year 24-25. Now, this is for individuals, and what this means for a lot of clients is we're going to have less exemptions to play with, and or clients are going to be paying more tax. If we think about the types of clients we work with, there might be some clients who use better and ISA facilitations. We might have clients who are selling investment properties, or we might have clients who are actively trading. So these exemptions are going to get used up much quicker because we've got less to play with. And while we're thinking about the types of clients we're dealing with, we also need to consider our trustee clients. Now, trustee clients get half of what an individual gets. So for this tax year, it's actually £6,150. But that will depend on how many settlements a settler has created. So if they've created up to 5, then that annual exempt amount can actually be split up to a maximum of 5. And if we think about what is going to happen over the new 2 tax years and that reduction coming in, it means that for trustee clients, we're actually going to be looking at £3,000 maximum in the new tax year. And then by tax year 24-25, £1,500. And again, these can all be split up to a maximum of 5. So again, there's going to be less to play with, and potentially trustees are going to have to be paying more tax. We also need to think about gifting and disposals. We know that gifting between spouses and registered civil partners is exempt for capital gains tax purposes. But if we're looking to gift assets which are subject to capital gains tax to any other persons, that's going to count as a disposal. And as we've already discussed, with less to play with, it could mean that we might be able to have to restrict what we actually give away and or pay more tax for it. Let's just have a look at a quick example about how it works for a discretionary trust going forward. We've got Mr. Jones here, and he's got a discretionary trust that he set up in May of 2017. Bought a portfolio of shares for 200,000. The value is now 265,000. What you can see here over the next 3 tax years is the gain minus the trust allowance and that reduction that comes in. So for this tax year, because they've only set up one trust, it's 6,150. And you can see here that the tax payable at trustee rates of 20% is £11,770. In the new tax year, that tax rises to £12,400 and rises again by tax year 24-25 to £12,700. Now, what that means for a lot of clients is, while there's an increase in tax, and that might be from a monetary point of view, not very much, from a consumer duty point of view, that's actually an increase of just under 8% in tax. What I'm saying here is we don't necessarily have to make a lot of changes here, but we do have to have a discussion with our clients, because under the cross-cutting rules, when consumer duty comes in July of this year, we need to make sure that we are acting in good faith. We need to make sure that we are avoid causing foreseeable harm to our clients, and we need to make sure that we're acting so that clients can achieve their financial objectives. An increase in taxation might actually hinder that. So while I'm not saying that we have to make massive changes to a lot of our investments, we do have to have the conversation, and then the decision has to be made. Another change that's came in, that's coming in the new tax year, which was announced in the autumn statement, was the reduction in the dividend allowance. So we know that dividends have been played around with since 2016, while we lost our 10% credit, and we had that introduction of the £5,000 allowance. And then in 2018, it got reduced down to £2,000. As you can see here, moving through to the new 2 tax years, so moving through to tax year 23-24, that dividend allowance is going to reduce down to £1,000 and then down to £500 by tax year 24-25. So again, we need to think about the types of clients we're dealing with here, where income for dividends actually comes in the income tax calculation, and also what other sources of income we have here. We also need to consider our trustee clients, because trustees don't have a dividend allowance here. This is only for individuals. Currently, trustees have a standard rate band. That first £1,000 worth of income, which is taxed as if it's basic rate. So if it was a dividend income, it would be taxed at 8.75. But what we saw in the spring budget that was announced was actually by April of 2024, there's going to be changes in relation to discretionary trusts, where they're going to introduce a nil rate band of £500 for low income trusts. And they're actually going to get rid of that standard rate band. We're waiting for more information and for this to be put into the draft legislation, but that's something that we need to be aware of when we're dealing with discretionary trustees and going forward, especially when that comes in tax year of 2024. With this reduction in the dividend allowance, thinking about our individual clients though, we need to think where that dividend income actually sits in an income tax calculation. And unfortunately, even though we've gone through an extraordinarily high period of inflation, the taxation system really doesn't care. The taxation system cares about how much money is going into your bank account. And while we have seen wage rises go up, they haven't been keeping pace with inflation because of it's been so high. People have been getting 4, 5, 6% pay rises. We also need to consider the fact that the Bank of England have put up their base rate for the first time in a very long time, and that's currently at 4%, which was decided by the Monetary Policy Committee a few weeks ago. Dividend income comes in after your non-savings and after your non-savings income and after your savings income. So it comes in, which comes in much later. So more clients are going to be paying more tax and potentially at higher rates because we're seeing those increase in wages and that increase in bank interest. What that means for a lot of clients also is that more clients are going to be potentially having to report this income via self-assessment tax returns. There's more administration that might be involved, so potentially more time and potentially more costs for clients as well, especially if they're not going to do their tax returns themselves. If we have a look here at this table on the 4% yielding portfolio, currently a £50,000 collective investment scheme or portfolio of shares, if it's £50,000 and below, then your £2,000 allowance actually covers the income that's being produced or accumulated. When it rolls through with these reductions coming through over the new 2 tax years, you can see the value drops, that the allowance will cover for that income, £25,000 in the new tax year, and then £12,500 by tax year 24-25. That's not even enough to actually fulfill your ISA subscription for that tax year. So just to be mindful, we need to be having conversations with these clients, because this is going to impact many different clients, especially those which have got those unwrapped portfolios. I mentioned about the order of taxation and why it's important. If we think about where that dividend income fits in, we know that first into any income tax calculation is your non-savings, non-dividend income. So that's things like your salary, your self-employed earnings, rental income, pension income, and your personal allowance there is used in the most tax efficient way. So used here to offset against this source of income first. Second in is your savings income, and that's things such as interest from your bank and building society accounts, corporate bonds, but also importantly here, gains made from insurance policies without a tax credit, so your offshore bonds. Now, gains from investment bonds are counted as savings income, but where they fit in an income tax calculation actually differs. Offshore bonds come in at number 2. Dividend income comes in at number 3, and as I've already said, because of the allowance being reduced, more people are going to pay more of their income at higher rates going forward, because there's going to be less allowance to play with. Redundancy payments after £30,000 comes in at 4, and then you get your gains from life assurance policies with a tax credit, so your onshore bonds come in at number 5. Now this is important when we're considering different clients that we're working with, their sources of income, and if we're trying to take money out of bonds, where that might fit in compared to what other income they are earning. So we've spoken a little bit about the taxation changes and why that's important, and why we need to speak to those types of clients, because they are going to potentially be paying more tax and at higher rates going forward. But let's just have a look at some features and benefits of why investment bonds might be an appropriate solution. If we think about an investment bond and how it's structured, we know that the legal and beneficial owner of those assets is the life company. So if you make any changes to the underlying portfolio, then it's actually a fund switch. Investment bonds aren't subject to capital gains tax unless they are a second-hand policy. They're subject to the chargeable event regime and chargeable to income tax. Lots of investment bonds now are made up of thousands of individual policies, and we refer to this as segmentation. And that's beneficial for a couple of reasons. One, it allows you to do an assignment by way of gift, and that tax efficient gifting. So if I was to assign my bond to my children, that is a gift from me to them. And so long as I don't get anything back and it's not done for money or money's worth, then it's a gift and it's a potentially exempt transfer from an IHT point of view, but it also does not trigger a chargeable event. If I was doing it for money or money's worth, it would trigger a chargeable event there. But also from a segmentation piece, if you've got thousands of individual segments, then the gain per segment when you do a full surrender calculation means that it's going to be much less. So you could be more pinpoint accurate when you're looking to withdraw money out, and you could do it in the most tax efficient way. And if you're working with tax allowances such as your personal allowance, personal savings allowance, and that savings rate band for income tax, the first £5,000, which is taxed at 0, then you can be working with that and be more pinpoint accurate when you're trying to withdraw money from a bond. If we're thinking about investment bonds and how they're set up, we know that they are non-income producing assets, so they make great trust investments, because from a trustee point of view, there's no ongoing reporting requirement unless there's a chargeable event. And also, if we're looking to register them under the trust registration service, it will go under as a reportable trust unless the trustees are paying the taxation on them, on the bonds. We also know that we can have 5% of the amount we've invested cumulatively rolled up over time over a 20-year period. That 5% tax deferred withdrawal facilities that's on investment bonds is a return of capital, so it's not income, so it doesn't interfere with any other income tax that you might actually be having to pay because it's return of capital. There's also certain reliefs that are available, such as top slicing relief, time apportionment relief, and deficiency relief that you could use to offset against some of the tax that might be due on gains. And if we're thinking about offshore bonds in particular, you have a choice of jurisdiction about where you want to set that bond up. So for example, Isle of Man or Dublin or Luxembourg or Jersey or Guernsey. If you're thinking about which type of clients you're working with, just by way of example, if you're working with clients who use DFMs, then under the Tax Consolidation Act of 2010, if you have an Irish domicile bond, then DFMs don't actually pay VAT on their DFM fee, so you save the clients a little bit of money there. You've also, looking at offshore bonds, got the choice between additional lives assured or a capital redemption policy. If we're thinking about it from a provider taxation point of view, you can have an onshore bond or you can have an offshore bond. An onshore bond means that you pay tax within the fund. And if you're a basic rate taxpayer or can assign to a basic rate taxpayer, then and you remain so upon a chargeable event, there's no further tax that's needs to be due on that. If you're thinking offshore bonds, you get that benefit of gross roll up over time. There might be some withholding taxes to pay depending on where you're invested, which are non-reclaimable. But in the main, that fund will go tax-free, which is a benefit to a client, especially if you're holding it for a long time. If we're thinking about some of the features and benefits for collectives, we know that if you make a loss on a disposal of a capital gains tax asset, then if you register that with HMRC within 4 years, then you can carry that loss forward indefinitely to offset against future gains, which is a real benefit. The tax rates which are chargeable for capital gains tax is 10 or 20%, and we haven't seen any changes in that. So it's much less than paying 20, 40 or 45%, which is your income tax rates. We know that capital gains tax dies on death. So the person inheriting that asset, the base cost is the value on the date of that person's death. But just be mindful, just because you save on capital gains tax, unless that asset is held in a trust, that asset could be inside the estate and subject to IHT depending on the other assets you hold. So if we're thinking about target market and from a consumer duty point of view, your typical client for an onshore bond is wanting a UK provider, be subject to UK regulation, be subject to the UK financial compensation scheme. It's going to be a UK resident throughout the policy term. And as I said, either going to be a basic rate taxpayer or have that ability to assign to a basic rate taxpayer so that you can have that credit when the chargeable gain occurs. People who have maximised their ISAs and pensions, so we saw in the spring budget that there's changes to pensions that are coming in the new tax year. The annual allowance is going up to £60,000. You're going to have different types of clients that you work with, and some people will be able to maximise those £60,000 on an annual basis, but you'll also have clients who can't. Some people that clients are starting off in their career who maybe only have their UK relevant earnings of 30, 40, £50,000, but they're also of an age where they're getting inheritances from family members and they're looking for investment solutions that they could use. So potentially ISAs, potentially investment bonds here because of some of those features and benefits that we've just discussed. The fact that there's not going to be a lifetime allowance limit going forward as well means that pensions is going to be looking a lot more attractive to those higher net worth clients. And remember, pensions are one of the best family trusts that we've got. We're looking at clients here who are investing over the medium to long term. We're also looking at clients who have utilised their allowances and their exemptions. Clients who want that tax efficient withdrawals, that 5%, being allowed to switch and change that underlying investment without a tax consequence, and that gifting. And those people who wanting to use trusts from an IHT planning point of view, but also because of the administration and reporting requirements are much less than if you are holding unwrapped assets. If we're thinking offshore bonds, as I said before, we get that benefit of gross roll up over time, but your typical client here as well is looking for an increased investment opportunity. So working with platforms, working with DFMs, working with model portfolios, potentially looking at different currency options as well. Again, they've maximised their ISAs and pensions where appropriate to do so, because ISAs will be subject to inheritance tax unless they're held in business relief assets such as an AIM portfolio, which is good for some clients, but because of their high risk nature, they might not be suitable for a lot of our clients. So it has to be suitable. The tax tail can't wag that investment dog. We're looking at clients who want to invest over the long term. We're looking at clients, again, who have utilised their allowances and their exemptions, and they're looking for that tax efficient withdrawal, switching, gifting, and looking to use trusts. If we're thinking about target market for collectives, we're looking at clients who want to take advantage of those lower rates, as I've already explained, at 10 or 20%. Utilising those capital gains tax exemptions and those dividend allowance. So we don't get much from HM Treasury, so we should utilise everything that we have available to us to build that holistic financial plan. For joint investments, if you're working with spouses or registered civil partners, if you can equalise the assets, you can make use of both capital gains tax exemptions. And remember, there is that startup exemption there. But also by doing that as well, especially if you have a disparity in the different taxpayers. So for example, if one spouse is an additional rate taxpayer, one is a basic rate taxpayer, if you equalise the assets, then you could potentially increase that household income. We're thinking about clients who want to use their ISA subscription and that bed and ISA facilitation on an ongoing basis as well, where it's suitable to do so. And importantly, if we are looking at these unwrapped portfolios, then those clients who are willing to take on those reporting requirements, either as individuals or as trustees. We said before about why segmentation is really important, and that you could be really pinpoint accurate when you're trying to withdraw money from an investment bond. If we take this example here, where there's been an original investment of 300,000, and over a 15-year period, we've assumed a 4% annual growth net of all charges. So the value of the bond is now £540,280. I mentioned before about the allowances available we have to play with. So we have our personal allowance of £12,570. We've got a personal savings allowance if you're a non-taxpayer or a basic rate taxpayer of £1,000, or £500 if you're a higher rate taxpayer. Additional rate taxpayers don't get a personal savings allowance. But you also get that standard starting rate band for savings income, which is the first £5,000 taxed at 0%. So potentially, if you're working with a non-taxpayer or the ability to assign to a non-taxpayer, you've got £18,570 to play with. So if you have this original investment of 300,000, and let's say that for those older style bonds that you might still be working with, there was 10 segments. What you can see here in the gain per segment column is the gain after 15 years is over £24,000. So if you were trying to assign one segment out to a non-taxpayer here, and for them to encash in their own name, you wouldn't be able to do so without them paying tax. If you compare that to 100 policies where the gain per segment is £2,402.80, you'd be able to assign 7 segments. You do the full surrender calculation, which means that they would yield £37,820, and the chargeable gain would be £16,819.60. 1,000 segments, a lot of industry standard here. Gain per segment is £240.28. You could take 77 segments, assign those, they can encash in their name. They could gain 41,601 and a gain of 18,501. But if you can split it up to 99,999, look at the gain per segment, it's £2.40. So 7,737 segments, £41,779. But look how close that gain is to the allowable allowances here. It's really, really close. And so you can be more pinpoint accurate when you're actually trying to withdraw money out, and be really targeted when you do so. I said before about investment bonds being good assets for trusts, and there is going to be a type of trust available for the different types of clients you're working with. From probate trust to gift and loan trust, flexible reversionary trust, discounted gift trust, controlled access trust, and those outright gifts to the trustees. A conversation will have to be had with those clients as to what access they need, whether or not they need income or withdrawals. And let's not forget about pensions. Those changes mean that as pensions are really tax efficient and they sit under a master discretionary trust in a lot of cases, they're a really great family trust, and with that lifetime allowance being removed, it could make them more attractive as well. But for certain types of trusts that we work with, only an investment bond would be a suitable solution here. If you think about a discounted gift trust or a flexible reversionary trust, collectives wouldn't be a suitable asset to be held in there. So potentially for other types of trusts, it might be, but remember those reporting requirements that the trustees would have for any income that's either taken or accumulated within that fund. And just before we conclude, just some other final points to consider when we're looking to build a holistic financial plan for our clients. We need to consider the time horizon for the investments, what that family dynamic is. Can we use spousal exemptions? Who's benefiting from this money? Is it the children, grandchildren? Is it a corporate investment? How actively are they looking to manage that money? Are they going to be trading a lot? If so, do we might want to take advantage of that fund switching benefit that investment bonds have? Are the allowances or exemptions being used elsewhere? Have they already been used, or are they targeted to be used going forward into the new tax years, especially with those reductions coming in? We also need to consider what the tax position is for the client and if that's likely to change in the future. We know because the additional rate tax threshold is coming down in the new tax year down to 125,140 from £150,000, there's going to be an additional about 125,000 people who are currently paying higher rate tax, which are going to fall into additional rate tax in that new tax year. Is that likely to change when they're looking to withdraw money out or appoint money out? Can they assign money out to somebody who's a non-taxpayer? And while tax is really important, it's not that sole factor. And I go back to consumer duty on this. The tax tail shouldn't wag the investment dog. The investment needs to be suitable, and we do need to consider risk and capacity for loss. And while there might be more investment opportunities available out there which might achieve an IHT saving quicker, such as VCTs and EISs, it has to be suitable for the client. And some of those can be high risk. So that needs to be a consideration when we're building this holistic financial plan. The bedrock of which pensions, ISAs, general investment accounts and investment bonds and trust planning. There is going to be different amounts that you put in there for different clients depending on their circumstances, but that is your bedrock, and that's where we can really add value to clients, is taking all of this information and applying it specifically to the clients that are sat in front of us. From a Canada Life point of view, we do have a mixture of investment solutions that are available to you. We have our offshore bonds, which are based in the Isle of Man or in Ireland, and that's our Premier account. We also have our flexible reversionary trust, our wealth preservation account, again in the Isle of Man and Ireland. If you want to know anything a little bit more about that, please speak to your regional account managers. We also have links to the AJ Bell platform, so you can use AJ Bell as your investment engine. We have a wide range of standalone trusts which are available on either a discretionary or an absolute basis to wrap around those different types of bonds as well. And just by way of support, on our Canada Life website, we have a wide range of materials, investment solutions, briefing notes, webinars, articles covering a wide range of tax and estate planning subjects, but also pensions as well. We also have a professional trust service that we are working with. If you want to know a little bit more about that, again, please speak to your account managers. And you have us at the technical team as well, who, if you really want to, you can drop us an email onto our ICANN technical team, and we can respond normally within 24 to 48 hours if you have any technical questions with regards to any of our products and service. And that just reminds me to say thank you very much for your time today. I hope you found it informative. All of this information is given to you, and it is intended for professional advisors only. Please be aware that there are subject to changes and there is new legislation coming out, and past performance is no guide to the future.
Okay, we've got our head of investment partnerships, Ryan Hughes, up next. And again, Ryan will be looking at what was a fairly torrid year last year for bonds, possibly a year to forget for all of us, and maybe looking forward to 2023, where the bonds are looking to be a little bit more attractive in terms of an investment proposition. So next up is Ryan.
My name is Ryan Hughes and I'm Head of Investment Partnerships at AJ Bell. Delighted to talk to you today all about fixed interest, with the title of the presentation, Are Bonds Back in Business? The first time that I've had to present on fixed interest for quite a while, because it's been a topic that really hasn't been a lot to talk about. But I think there is now. So let's crack straight on and see what we could go through. Just a quick agenda we're going to run through today over the next 20-25 minutes. I'll give you a quick update on AJ Bell Investments, and I will also then try and talk to you about Henry VIII and how that relates to modern day QE and fixed interest. And then I'll do a brief run through of what went wrong in 2022 in fixed interest, and try and touch on, are things different today? And in which case, how have we had to adjust the AJ Bell portfolios, both the funds and the MPS, to cater for what could be quite a different and changing environment. So let's look just very briefly at an AJ Bell Investments update. I know lots of you have supported the AJ Bell investment solutions. We're very, very grateful for that, so thank you for your support. As you can see on the screen here, our assets have been growing nice and steadily, and we've gone through the 3 billion mark on the team across our range of products, and we're very, very grateful for you for supporting our investments and putting your clients' hard-earned money with us. We never forget whose money it is. We're also growing the team out there as the assets are growing, to make sure that we can keep delivering the great service that so far you've been receiving from us over the last few years. So there's new additions to the team, and we hope there'll be more during the course of this year as well. I think also what I really like about the way that we manage the investment solutions is this commitment to keep reducing costs, and that is a genuine commitment that we've been giving to the market for all the time we've been operating these investments now, well over 5 years. And when I launched the funds right back in 2017, as it was then, we launched the funds, the AJ Bell funds, with an OCF of 50 basis points, and now they're right down at 31 basis points. So you can see that as we've grown, as our AUM has grown, as that chart shows, we've been able to pass on the benefits of those scale to investors and drive down the cost of investing, something that we're absolutely committed to keep on doing. Delighted to win a Citywire Investment Performance Award for 2022. Really, hopefully a good validation of the performance that our solutions have delivered, not just last year, but actually for numerous years before that as well. And we'll look at that in a little while. And also continuing to widen out the availability on other platforms that we have. And so we are expanding the offering and continue to do so. So if you'd like to see the AJ Bell Investment Solutions on other platforms, then do please get in touch, because very often this is driven by demand. And the more demand that we know of, the more we can put pressure on those other platforms to give access to you via all those different platforms that are out there, of which of course there are very many these days. So let's crack straight onto the meat of the presentation, which is all about Henry VIII and modern day QE. And you're probably thinking, how are these two related? What's Henry VIII got to do with QE? But I think to do that, I probably need to take you back on a little history lesson. And what you can see on the screen there is a picture of Henry VIII, of course, and then 3 other gentlemen that you will recognise as two previous and 1 current governor of the Bank of England. Now, what have they got in common? I hear you ask yourself as you look at this slide. Well, if we think about Henry VIII, then he had a reputation for spending a lot of money, and he actually inherited a fantastic fortune from his father, which was £375 million in today's money, a huge amount of money. Never needed to worry about inheritance tax planning. Obviously, he wrote the laws of the day, so no need to worry about all of those taxes and trusts that we get stuck into today. But the trouble with Henry VIII is he loved spending that money, and he particularly loved spending that money on war. He went to war in many different countries, particularly France. You can see a map of France over my shoulder there, due to me having a French wife. So Henry VIII was certainly warring with my wife's ancestors, as it was back then in the 1500s, but he also was warring with the Roman Empire and indeed the Scottish, many wars with the Scots up there in the north of Britain, and these wars were ruinously expensive, and Henry VIII ran out of money. In fact, he didn't actually have enough money to do all the things he wanted to do for his 6 wives, his wars and his palaces and all of those things. He ended up actually running out of money. But the very good news for Henry VIII was that he actually controlled the Royal Mint. The Royal Mint was based in the Tower of London, and in that Tower of London, he tasked the Royal Mint with making some more money. And now, in those days, your coins were made out of gold and silver, and therefore you needed a plentiful supply of gold and silver to make those coins. But the trouble is that England didn't really have any money because Henry VIII had spent it. So he had to find a new way of coming up with some additional money. And what he tasked the Royal Mint to do in the Tower of London was actually mix some copper in with his gold and silver to effectively make it cheaper to create new money. And in that way, he could finance those things he was spending his money on. And that actually went reasonably well in the mid 1500s for a couple of years, as he was producing all of this extra money, and it was finding its way into circulation, and the merchants were using it to trade with our trading partners overseas and so on. And it all was going well until the Flemish merchants, who were doing a lot of trade with Britain at the time, realized that the coins that they were getting didn't seem quite right. Now, we will all know that when we get a brand new coin from the Royal Mint today, it's lovely and shiny, it's got nice sharp edges, a very clear image of the monarch of the time. I haven't actually seen one of the new king yet, but it won't be long before we see those in circulation. But it was exactly the same with the coins of the day. When they were newly minted, they looked absolutely fantastic. But we know that as our coins pass through our various hands, as we spend those coins and they touch all the different people over the years, that those coins become slightly tarnished. And what the Flemish merchants found was that those coins were actually, the silver on the coin, on the face of Henry VIII, was actually starting to rub off. And what they saw underneath was not something they were very happy about, which is they realized that some copper had been mixed in with the coins, and effectively Henry VIII had embarked on some kind of medieval QE. He'd started to devalue the pound there, and he was doing that by mixing more and more copper in with the gold and silver. And actually, where it started rubbing off on those coins was the most prominent part of his face on the coins, which of course was his nose. So Henry VIII is known as Old Copper Nose because of the fact that his nose was a very copper-coloured nose on those coins as they passed through the hands of the Flemish merchants. But of course, he devalued sterling and found his way to some kind of medieval QE. Now, if we look at actually what he did there, if we look back in history, and we can see in the 1520s, a coin was, this is before he embarked on this process, which was known as the Great Debasement. A coin actually had about 92% silver in it. But in the 1540s, when he started the Great Debasement, he'd actually managed to cut the amount of silver in his coin to around half, actually. And then just a couple of years later, when he was still needing to make even more money, then he'd cut that to a third. So a really significant devaluation of the pound as it was there. And to say those Flemish merchants suddenly realized that actually they needed more pounds from the traders to buy the goods from them. The pound had been devalued, and therefore it wasn't worth as much, and therefore they wanted more in return. All sounds very, very reasonable, and probably all sounds a little bit familiar too. But let's look at what the Great Debasement, what it did to the English economy of the day in terms of inflation, because this is where I think it gets really interesting, and we can learn a lesson from that medieval QE from where we are today. The Bank of England has some amazing statistics on its website that go back a very, very long time. And I've managed to dig out these statistics from the Bank of England website, giving us inflation data back in the 1500s. So we really are looking a long way back in time. Now, 3 bars on this chart. The first bar actually includes a portrait of the young Henry VIII. I'm not sure many of us would recognize that portrait. We're much more familiar with him in the picture we've got in the middle there. But you can see in that very first bar that for a very long period of his early reign, that inflation actually was under control, was very, very low. at around that 1.5% mark, and it's remained stable for a very long period of time. But you can see that middle bar when those Flemish traders realized that the flood of money had entered circulation and that money had been created effectively out of nothing. It wasn't the value of that money wasn't anywhere near as big as it should have been, just as we're seeing today, that we saw inflation in medieval England shoot up to 6.7% for a period of 7 years. Now that is about 4 to 5 times higher than they had seen in England for the preceding 40 to 50 years. So it really was a very, very big sea change as this flood of money had hit the economy and devalued the pound. Now, it was only after Henry VIII's death that the subsequent monarchs realized that they needed to regain England's standing in the world as a trading nation, and to do that, they needed to put the silver standard back, to take it back to 92.5% and take this copper out of coins. And to do that, they had to take the excess money out of the system there and melt it down and separate out the copper and use the gold and silver to make more coins. But in doing that process, which actually took a very long period of time, it took the best part of 50 years, it was actually quite successful. And you can see that for the 50 years after the Great Debasement, that inflation actually reduced quite substantially and was back down to a level of more like 0.7%. So hopefully that little quick snapshot in the history of Henry VIII and the Great Debasement and medieval QE, you're probably sitting there thinking, some of this sounds quite familiar. And it sounds familiar for a very, very good reason. So let's bring it right up to date and think about where it all went wrong in 2022. So Western governments have gone full Henry VIII. They have spent the best part of the last 15 years creating money. We saw medieval QE in the Tower of London. We've then seen the modern day QE in the Bank of England, where it's now a computer that makes the money rather than the coin presses of the day. But the chart on this slide shows just UK government debt and just how much it has increased since 2008, since the financial crisis, on a consistently upward trend, and then an acceleration of that trend as we reach the COVID pandemic and Western governments unleashed a flood of monetary support into these economies. So as we unleash this wave of money, just like Henry VIII saw, to me it seems very, very logical as to why we've got a period of high inflation like we have now, which is we've had too much money chasing too few goods. Now it's a very, very convenient reason to point all of the blame at Russia and high energy prices for why we've got this high inflation. But this kind of wall of money that was coming behind was already, we'd seen asset price inflation before that. Long before that, most asset classes had gone up and hit record highs at various points over the last few years. And of course, you've seen things like Bitcoin and art and horse prices and all those types of things that have all gone through the roof at various stages over the last few years, as this flood of money has to find a home to go somewhere, and people want to put it to work. So we've got this wall of money that's gone into the economy, and now quite rightly investors are demanding a higher expected return from those investments if they're prepared to lend money to governments and companies. It seems perfectly rational that the risk has increased and therefore they want a higher return. And as a result of that, their confidence has taken a very, very big hit from the confidence in central banks has taken a very big hit as it's harder and harder to trust what they say, and the fear of devaluation continues, even if it's devaluation by stealth rather than a very, very overt devaluation. So because of all of that, interest rates have had to rise sharply during 2022. And again, that doesn't really come as too much as a surprise to us, because the trend was there, the wall of money was there. This is not a new phenomenon. This unleashing of QE, we'd say we're talking about a 15-year period in history that was going on, and so rates have had to go up to entice more and more investors to lend money to governments and countries. So let's look at actual performance. Well, bonds had a terrible year in 2022. I think many of you will be aware of that. In fact, it was the worst year for US Treasuries for 125 years. there. So we really are going back a very long time in history since we've seen a period as bad as this. On this slide, in the top left-hand side is a chart of different parts of the bond market with two different coloured bars. We've got the blue bars there, which represent the return of different parts of the bond market in sterling, and we've got the red bars that represent different parts of the bond market in local currency there. Now, what we can see is that sterling devalued during 2022, and therefore, actually, if you were owning overseas bonds, you had some insulation from the very worst of it. But let's not sugarcoat this. This was a particularly difficult year, pretty much wherever you were in whatever asset class you were in. Gilts off close to 25%, index-linked bonds losing a third of their value, despite a period when inflation is very high, which I guess we get lots and lots of questions about why index-linked bonds have not performed well in the period of high inflation, and that's all to do with where the real interest rate is, which is still not appealing there. So it really has been a very, very challenging period for bonds, and particularly in the UK, where our economy is essentially funded by overseas borrowers. It's not really the UK investor that's lending money to UK governments to finance all of our spending. A lot of it comes from overseas. On the bottom right-hand corner there, you can see an annual return of the UK gilt market over the last, well, nearly 40 years there. And you can see far and away, this is the worst year that the UK gilts have had in that period. In fact, there are only, where are we, 1, 2, 3, 4, 5, 6 down years in that entire period. The previous worst year was 1993, just after the pound crashed out to ERM. So again, perhaps we can see that devaluing your currency is not a great strategy if you want to have good returns for fixed interest. Just a final point to make on this slide here is the inflexible nature of the 60-40 strategy. Now, lots has been written about 60-40 strategy, but last year it suffered, and it was very much a case of being inflexible. Its lack of flexibility that stopped it delivering. So they don't have the ability to shorten duration. They don't have the ability to change credit quality because they're beholden to the index there, and therefore that lack of flexibility really hampered them in the way that we operate our own strategies. We have a huge amount of flexibility to adjust the portfolio to the market conditions we are in. So is it different this time? We spent a lot of time there looking at history. How is it different now? Well, interest rates have repriced. Over 350 interest rate rises during 2022 around the world, and you can see on the chart here the 10-year gilt yield, just how quickly the interest rates have risen, and therefore, of course, bond yields have risen alongside that. Now, it's very much the case that for me, that it wasn't the fact that rates have repriced that should have been a surprise. It's the speed of the repricing that has caught the market out, and that's why we've seen the level of volatility that we have. I think it was fairly clear. Well, it was fairly clear to us that interest rates had to go up. After all, they've been at record lows for the best part of a decade. And unless you're a believer in negative interest rates, then it's highly likely that rates were only going to go up. The key was really, what's the catalyst? What's going to drive them up? And of course, Ukraine and energy prices and so on have had an element of being an element of the catalyst in that, but it's not just that's really been driving that. It is that wall of money behind that's been ultimately pushing those rates higher. So the key question now is, where do rates peak? What is the terminal rate? That's the phrase that is known where interest rates peak in the cycle, because just about all assets are priced off the bond yield, and until the market gains some confidence as to where interest rates and therefore bond yields are likely to peak, it's very hard to price some assets with certainty out there. Now, I think there is some good news on the horizon. You will have been reading and hearing over the last few weeks that it seems like inflation may well have peaked, and if we've had inflation peaking, then we should be close to having interest rates peaking as well. Now, of course, we've seen in the run up to the end of 2022 and indeed into 2023, we've seen equities and bonds rally quite hard. In fact, the gilt market's up about 15 to 20% from its lows back in September. So it really is quite a big move in the gilt market over quite a short period of time. And that is all to do with the noise is coming out of central banks that they think rates might be closer to peaking than we thought at the back end of last year. But I think we also need to be cautious. These assets are not rallying because we all think the world is fixed and that central banks have done their job and all is well with the world and the economy again. I think a lot of this is to do with short covering. It's all of those investors that were betting on rates going higher than the market expected and inflation staying higher than the market expected. And now they're thinking that's not the case. Well, they better close out those shorts and buy back those assets. And that's been driving asset prices higher. So I think it is right to maybe just tread a little bit carefully and have an element of caution in terms of what we've seen over the last 8 weeks with the way asset prices have rallied. But there are definitely positive signs out there, and we should be encouraged by that, particularly with where rates are, and that's what we'll look at right now. So where are rates today? Well, this chart here is the dot plot. The dot plot comes out from the Federal Reserve after every meeting, and you can see the straight line of dots there at the end of the year. This is when the Fed put out their dot plot for the end of the year. You can see where the interest rates were, and that each dot represents a voting member of the Federal Reserve. Now, across the chart, we can see it goes to 2023, 24, 25 and beyond, and the dots start getting wider and wider as each voting member of the Fed becomes less and less certain as to where interest rates will go during 24 and 25. But I think what we can see is, as we look through to 24 and 25, that rates start to appear that they're likely to go lower. Now in 23, currently, the dot plot's telling us that they expected rates to go higher. Since they did this dot plot, we've had one rate rise, and in fact, the Fed's telling us that there might be some more relatively soon. But that's all priced into markets. That's not new information. We know all of that, and that's why bonds have sold off as they have, and yields have gone up. But what's much more interesting to us is what's likely and potentially going to happen in 24 and 25. And as you can see here, the consensus among voting members of the Fed is that interest rates should fall. And as we know, falling interest rates is a positive story for bond prices. So this is why, another one of the reasons why we've seen the bond market rally, because the bond market and indeed the equity market, they're not focusing on the here and now. The here and now is in the price. What they're interested in is 12 months down the line, 18 months down the line, and what's going to happen then. And if they're seeing that they think interest rates are going to be lower, then of course they're going to be wanting to buy bonds today to benefit from those cut-in rates in 24 and 25. Now this dot plot here is pricing in a rate cut of about 2% by 2025, which would be quite material, be beneficial for bonds. So I think there's a lot to think about out of the dot plot there, and it's a really useful thing to Google and look at every time there's a Fed meeting and see how things have changed. So thinking about our portfolios and thinking about bond markets, it's worth just looking at where yields are, and these are slightly out of date, only a little bit out of date from when we were updating our asset allocation in January. And I've got here the inputs of different parts of the bond market in terms of what the yields have been as we've approached the end of each of these years, 2020 through to 2023, what the yields been on different bits of the market there on either the 10-year gilt or the corporate bond index and so on. Now you can see here that there has been a significant repricing of interest rate risk there, of bond prices. We can get a yield of about 3.5% on a UK 10-year gilt today, compared to about 0.9% just 12 months ago. The bit that gets me really interested is actually investment grade corporate bonds, because when we cut this data, they were offering a yield of nearly 6%. Now it's a little bit down from that now, because as I say, they've rallied off their lows, but a yield of 6% on an investment grade bond where the default risk is incredibly low as judged by history, that to me sounds quite appealing, particularly when we have those expectations that inflation should fall back. Now inflation is a rolling 12-month number, and so we've got the very steep increase in energy prices from 12 months ago falling out of the calculation, and therefore very naturally we've actually got, it's not almost a guess, we know in the way that it's calculated that inflation will fall as those numbers come out of the back end of the calculation. So we get inflation falling below 5.9%, and we can buy investment grade bonds that are yielding more than that inflation rate. Then we're able to start generating a real return from fixed interest, which sounds really, really appealing. It's not just global investment grade, it's high yield too. We've got high yield at over 9% here. Again, it's come off a little bit since I put this slide together, but high yield is yielding more like equity levels of return. And EMD too. Yes, of course, there are risks with EMD, but risk and investment is all about ensuring you're being compensated for the risk. What we've seen in this chart when we look at the previous years is you weren't being compensated for the risk historically, and it feels to us like 2023 is a very, very different picture. So how have we navigated that? How have we been positioned, and what have we done to adjust as the world has changed around us? Well, just looking back a little bit in history, I've taken data here from our balance strategy over the last 5 years, 2 different pieces of information on here. The first chart, each one of these slices represents a duration bucket. And if we start at the top in blue, then that's a very, very short duration. And as we go down there, it gets longer and longer duration. Over the past 5 years, we've been really, really worried about rising interest rates and what had to happen in the bond market, because rates just felt to us like they were just too low. They had to increase, but we weren't sure when. But as that wasn't really materializing, we wanted to protect the portfolios more and more. And so over those 5 years, we took our short duration position from around half the portfolio of the element fixed interest, that is, to more like 2/3 there. Now, what we knew by it being short duration is that if we were right, we would manage to protect capital in the portfolios. And if we were wrong, we would make just less money than people that were longer duration than we were. And that sounded like a pretty good position to be in when rates are at record lows and we feel like they really can only go one way. So we've been increasing our exposure to short duration as we went through the last few years. The bottom bit of this chart is all about credit quality. And again, starting with the blue, we can see there's the highest credit quality in the market, those AAA bonds. And if we go down and down and down and down, then we get to below investment grade there. Again, what you can see, particularly around the start of 2020, was that we significantly increased our exposure to the highest quality bonds, AAA bonds, bonds issued by the US government in dollars there, because that gave us very natural diversification and also a great hedge in the portfolio. If things got really ugly, we would expect the dollar to rally, and indeed we would expect that element of bonds of credit quality to also outperform the investment grade, the US Treasury bonds to outperform corporate bonds and high yield and so on. So we increased our exposure to the highest quality bonds, that is A+ there, from about 30% of the fixed interest element to around half. Now, of course, that was history. That was for an environment where rates were incredibly low, where it was hard to see where you could generate a really good return from fixed interest. But as I've just been explaining in the previous slide, it feels like the world has changed and we need to adapt the portfolios to counter that. So what have we done in the portfolios just recently? Just in January, actually, as we updated the funds and the MPS strategies. Well, perhaps unsurprisingly, if you've listened to the last 20 minutes of this, we've increased our exposure to fixed interest by between about 3 and 9%, depending on which portfolio you are in. Now, we've marginally increased duration, just a little bit, by about half a year. The yield curve remains very flat, if not inverted, actually, a little bit. And that means that if you're lending money to a government or a company over a longer period of time, you're not actually getting increased returns for the extra duration of the time of that loan there. So if you're buying a bond from an investment grade company, whether you're buying that bond that's got a 2-year life, a 5-year life, a 10-year or a 20-year, we're actually roughly offering you the same amount of return. But of course, we know the risk of lending money to a company on a 20-year basis is very different to a 2-year basis, because we should have much more confidence that in 2 years' time that business will be there to pay us back, compared to the uncertainty of 20 years. So we don't want to add too much duration. What we have done is certainly changed credit quality. As you could see in my slide a couple of slides ago, the yield available on investment grade bonds versus government bonds looks very, very appealing. And therefore we've made a reasonable size shift from those government bonds into investment grade bonds to try and lock in that higher yield, that higher potential return. So that's meant selling out of some of those US treasuries and buying investment grade corporate bonds around the world there, and getting that yield pickup. Now we've also increased high yield there, and I know that immediately some people may think, well, that sounds incredibly risky, but it's important to understand where we funded that move from. And really that's been funded from equity. And there's, again, if we think 2 slides ago, I was showing that high yield is offering returns on that side of 9%, but it's certainly between 7 and 9% at the moment. And if we think back in history, well, the equity markets offered us a return of about between 7 and 8%. If we look at long-term, over 100 years of data, that's what equities have done. What we're seeing today is that high-yield bonds are offering equity-like returns, but of course, high yield doesn't carry the same amount of risk as an equity. If we buy the equity and it goes bust, we get wiped out. We get nothing back. If we buy the high-yield bond and the company goes bust, there is a recovery rate there, and you should get some of your money back. So therefore, if we can get an equity-like return, but for lower risk, that feels like a good move for the portfolios. And so that's exactly what we've done in moving some of that money into high yield, again, last month when we made those changes. Now, those of you that have used our strategies over the last couple of years will know that we've had some explicit inflation protection in the portfolios. While inflation is now, say, rolling off, and the US tips, which is what we're owning, we've sold those down and locked in the profits on those as the outlook for inflation feels somewhat different today. So just going to bring that together and think about the expected return on the overall portfolios as we update these on an annual basis. Some of you would have seen this chart before, so slightly busy, a little bit going on. I'll just explain it briefly. So the triangle in the middle there of each of those bars is the expected return for each of the portfolios based on the expected return of the underlying assets, because that's part of our inputs, and therefore we can get an expected return on the output. So if we use the balance strategy as an example, which is the number 3 there, then that's got an expected return of 7.5% per annum. Now the bars around that are how we would expect those returns to look across a multi-year horizon. So 80 years out of 100, we would expect the return of that same balance strategy to be between -5 and +21%. 20 years out of 100, it'll be outside of that range. Might be on the up, might be on the down, and of course 2022, when we've seen such a year where bonds have their worst year for over 120 years, it shouldn't be much of a surprise to imagine that a lot of those returns were around that kind of bottom tier of that bar. But if you're doing cash flow modeling and planning, then hopefully this type of information is useful for you when you're mapping out your clients' cash flow planning for the next 10 or 20 years. So just want to touch on performance, just very, very briefly. This is a traditional way of looking at performance. We're very, very proud of these performance numbers. These are the AJ Bell funds, but the NPS is essentially a mirror of that. They're particularly proud of the Cautious Fund being first in its IA sector over 5 years. It's been really, really challenging running cautious portfolios, as you've just seen in terms of how bad bonds have been. So to be able to navigate that and be top of the sector is something we're very, very proud of. And then it's true really when you look across the board of the range there, that they've all got exceptional long-term numbers there. But I also want to look at performance in a slightly different way there, which is just showing you the quartile rankings over the last 5 discrete years. Now, something in common with 2022 was 2018, where it was another negative year. Now, in both instances, the portfolios and the NPS have proven to be very, very robust. And that's helped by the embedded diversification, by the flexibility that I talked about, being able to be short duration, being able to adjust your credit quality in those portfolios. Obviously, I've talked today about fixed interest, but there's been lots of things going on in the equity market as well, and the equity positioning that we've done. But the nice consistency of those numbers by year for us is something we are very proud of. 2020, it's worth just noting there, obviously there are a few third quartiles. 2020 was a positive year for markets. So yes, they were third quartile, these strategies, but they made good, positive, absolute returns there. And if we can get that return profile where we're doing a very good job on the downside and managing to keep up on the upside, that's a great way of compounding wealth over time. After all, the easiest way to make money in the long run is not lose it in the short run. And that's exactly the performance profile that we've seen over the last 5 years of the AJ Bell funds and strategies. So let's bring all of that together. We talked a lot, we've looked at history, we thought about Henry VIII, about money creation, about how that links to modern day QE. There's a lot going on in all of that, and hopefully that's a useful kind of just a thought process really of thinking, okay, perhaps we shouldn't be so surprised about inflation and where it is today. But 2022 was really a standout year in a bad way for fixed interest, as the culmination of so many events came together. COVID, see the terrible war in Ukraine, the wall of money that's been flooding into markets since the financial crisis in 2008. So it's a long process that's got us to that terrible year. But it shouldn't have been a surprise. It seemed clear that interest rates had to go up, and it seemed clear that inflation had to rise. And we have the flexibility in the portfolio to be able to adapt to that and position for that and benefit from it. But it's a very different world today, and we've had to adjust and change the portfolios again to make sure that we're well positioned for the world we're going in, not just the world we're coming from. The one we're going into may well be higher rates than we've seen over the last decade and higher inflation than we've seen over the last decade as well. And it pretty much means that you might want a slightly different portfolio to prosper from that than the one that did well over the last 10 years. So long-term performance remains strong. We're very grateful for all of your support for those who've given it over the years and in helping us grow. We hope you've been pleased with the returns thus far, but we never rest on our laurels. There's much more to do, and we continue to drive down that cost of investing and try and get those funds and those models, those MPS service, as low cost as we possibly can to keep driving that performance forward. So thank you very much for listening. As ever, if you have any questions or queries, then do reach out to your normal AJ Bell representative. They'd be delighted to hear from you. And of course, we would too in the investment team if you want to talk in more detail about anything I've spoken about today or anything going on in the portfolios. So I'll just leave it there and look forward to speaking to you again very, very soon. Thanks very much for listening.
And making his on the road debut is our investment sales BDM, Andrew Adshead. He'll be just looking at a quick refresher of what's been happening with the portfolios, how they're positioned, and how we expect them to look over the coming years based on our new tactical and strategic asset allocation. So over to you, Andy.
Hi, welcome to AJ Bell Investment Update on the road. You may be familiar to some of you. My name's Andy Adshead. I look after the investment solution for the North, which actually incorporates working quite closely with Billy Singh, who's in the Midlands, Andy Witter, who's in Manchester, Liverpool, pretty much the Northwest, Matt, who many of you will know, who's in the Northeast, and of course Kenny, who's in Scotland and Northern Ireland. So got some great information to pass on this webinar. You can see there on the slide what's impressive growth in terms of AUM. So for those of you who are supporters of ours, then from me certainly a big thank you. And from those of you who are just looking at AJ Bell's investment solutions, perhaps for the first time, a little confidence in that there are plenty of others of your peers that are recommending us with significant gusto, I think is probably the term I'd use. And it's nice to get some independent, I suppose, accreditation. So if you cast your eye to the bottom there of the page, so Citywire Investment Performance Awards for 2022. So this is one that the team should be particularly proud of. It was best investment outcomes. So ultimately the client's journey, the client's end investment values, and managing what's clearly in 2022 was a very difficult year. So as the slide suggests, push through the 3 billion barrier. That was towards the back end of last year, closing in on the 4 billion barrier already, and we're only in the middle of March of 2023. So great to get some independent views and some third parties that are providing recognition of the growth that's gone on, but the widening availability of third-party platforms. So buying the solutions on platforms other than AJ Bell has led to that enhancement in terms of capital values. So it would seem logical to then, from your perspective, to want to understand why that growth has taken place. So first we'll run through what we offer, and then you can gain some understanding of what other IFA firms have been purchasing from us. So 6 risk-targeted risk profiles that are aligned to distribution technology from a risk targeting perspective. So take comfort that there is a governance framework that ensures that the risk profile you choose will be maintained. So these portfolios aren't volatility managed, the volatility coefficient, if you like. They're managed to a volatility corridor to ensure that the governance, your governance and your recommendation means that if you say to the client's a balanced investor, a DT5 or the equivalent on a different risk profiler, so they've been matched to other solutions, take some comfort that it'll maintain its risk profile. So 6 risk profiles, 3 through 8 on a 1 to 10 scale with DT. And then what do we implement? So there are 5 implementations of those portfolios. There's a passive range, which is passive by name, perhaps not in nature. There's an active range, which is the same asset allocation, so exactly the same asset allocation as the passive range, but actively implemented in terms of the fund choice and the fund research inside. And then there's a passive range, which, as you can imagine, is a 50-50 blend of those 2. So 3 portfolios, risk targeted, passive, active, and then a blend of the 2. Then there's a responsible range. Clearly be happy to talk more about how the responsible range works, but there's a distinct framework that runs through that responsible range to ensure that the nature of the client that wants to buy that type of proposition, there's a monthly ongoing process to ensure that the stocks inside meet their criteria. And then there's a growth fund range, so a unitized range with individual CDOL codes. And we're seeing huge increases in the number of IFA firms that are looking to use CEDOL coded, so unitized versions of these funds. In this example, the growth fund range is a unitized version of the passive MPS. And why such significant increase in the unitized range? Absolutely down to capital gains tax changes and the ease with which investors can invest in general investment accounts, and you, the advisory firm, can then time and start to manage their CGT liabilities clearly as their allowances fall in the coming months or years. We also run an income range. So there are 3 implementations of the income range. There's a passive version, an active version, and again, importantly, a CEDOL coded unitized version. There are 2 variations, of course, of that income range. So there's an income range which has a target yield of between 3 and 5%, and the idea is that we preserve capital, so people taking withdrawals. The idea would be they would touch the capital, try and survive off the yield where possible. And then an income and growth range, again targeting 3 to 5% in terms of yield. But the idea is that under, let's say, normalized inflation, the capital value would grow over time. So that's what we do. 6 accumulation, couple the income focused, and the income range could be applicable to pensions, it could be applicable to ISAs, and is equally at home in either tax wrap or indeed in general investment accounts. Cost. So I guess on everybody's lips in terms of consumer duty, whilst it isn't all about price, clearly it certainly helps. So you can see that the passive range, largely 28 basis points, so 27 to 28 basis points towards the top or centre of the screen that's in front of you. The CEDOL coded range is 31, so a great story there. The fund range started life at 50 basis points about 6.5 years ago, and is now running at 31. So whilst scale has helped and different share classes have helped, and those cost savings have been passed on to the end investor. So, you know, one of AJ Bell's commitment on cost, being a low cost provider, is exactly that. The fact that the scale and cost savings have occurred, then the end investors enjoying a lower charge proposition. The active range ranges from 55 up to 92 basis points for the global growth fund, and that's just a reflection of the assets inside. So graduated in terms of cost where there's more fixed income. Okay, so let's move on to I suppose what may be on everybody's lips, which is, well, great. So the low cost proposition, you've got some awards, fabulous. You've got quite a hearty range there of accumulation portfolios and some that can be used for income. So how are these portfolios performed? And clearly it's pleasing from my perspective to show you this slide. But if I was looking at it perhaps for the first time, I'd be thinking, so the cautious fund, 4th out of 64, 3rd out of 52. So we're talking top decile performance. In fact, as you go down the different risk profiles and across the timelines 1 through 5 years, you'll notice that they're all top decile or top quartile at worst. And for some of you may say, well, okay, so what additional risk was taken in order to get that type of performance? But if we think about the last 5 years, as a great example from 2018 through 2023, there's been some turmoil. You know, 2018 was a difficult year. 2022 clearly was a very difficult year. There was some tricky times in 2020, although that was a growth year overall, wasn't it, where there was quick falls and speedy recoveries. But there's been a great deal of change in that 5-year timeline, and it isn't undue risk or additional risk that's pushed these portfolios to the top. It's been what I would call a ribbon that runs through the portfolios, where each member of the investment team would say, somewhat of a strap line would be, it's easier to make you money long term if we don't lose you as much when the market falls. So if we can control the downside, it's easier to recover from an elevated position than it is to suffer the full loss and then have to recover losses first before we then make gains. And it's that nature of this investment style that has led to these statistics, you know, top decile, top quartile performance characteristics over time. So it's not additional risk that's been taken, it's management of downside and then gaining good ground on the upside as well. That's all for me. Hopefully I'll meet more of you in the field in the coming weeks and months. Thanks very much for your time.
And finally, to finish the day is Lisa Webster. So a number of you have probably seen Lisa on our online and offline sessions. Lisa is part of our excellent technical team here at AJ Bell. And Lisa will be running through what the FCA and HMRC have had in store and have in store for us over the coming months, and also just a quick refresh in terms of some of the think tanks and what their thoughts are on possibly where pensions and investments may be heading from a taxation perspective and a limitation perspective over the coming years. So again, Lisa, I'll hand it over to you.
So hello and welcome to my technical roundup session. On the agenda today then, I've got to start off by going through some of the tax changes we've had recently, a few of those, and then I'm going to cover and update the latest of what's been going on at the FCA, and I'll finish off with a bit of other industry news, bits and pieces from round and about. So starting off with tax changes then. So we did these roadshows, physically going out around the country in February time. So obviously then I was talking, a lot about the things that come out in the autumn statement, the changes that we're having, which are coming into play from 6th of April. I'm recording this now just after the budget, so we have some rather bigger news in pensions world, I think, that has just landed. So we had the big bombshell about the lifetime allowance. There was lots of rumours in the build up to the budget that something was going to be done about the lifetime allowance, that it was going to be dramatically increased, going back up to 1.5 million or 1.8 million, but I don't think anybody really expected it to go completely. The important thing to note on this with the lifetime allowance is that it's actually only being abolished from 6th of April 2024. Not 23. There are changes coming in from 6th of April 23, but it's not going completely. It's a two-stage process, which is really, I think, just down to the time frame. The announcements come out on the 15th of March. They can't make all the changes necessary to legislation to remove it completely by 6th of April 23. That it's going to take another year to get that legislation through, make the necessary changes. What they are doing, though, is making sure there's no lifetime allowance charges from 6th of April 2023. So, if you have clients that are crystallising benefits in excess of the lifetime allowance in the 23-24 tax year, they won't have associated tax charges, lifetime allowance charges with those. You will find your providers will still be asking for information about available lifetime allowance, protections, etc., because it looks like we're still going to have to do all the reporting to HMRC in exactly the same way as we have done up until now, and still send out BCE statements and things like that. So that isn't changing. But the actual tax charge, if we work out, once we've done the calculations, if we work out at the end of it that, there is an excess, just the tax charge won't be applied. So the 25% lifetime allowance charge, when you put funds into drawdown on the excess, that's going completely from 6th of April. If you're taking a lump sum in excess of the lifetime allowance, instead of the 55% tax charge, what you'll have instead is that will be taxed at the individual's marginal rate of income tax. As I'm sat here talking now, the draft legislation of exactly how that works isn't out, so I haven't seen all the finer details on that, but are planning on doing another webinar once we have that information and we've analysed it to go through these changes in more detail. So we'll come back to you on that one. One thing to remember is sort of like the sting of the tail, if you like, with the lifetime allowance being removed, is that PCLS is going to be capped. So it's going to be capped at the current level, which is 25% of the current lifetime allowance, so it works out as £268,275. I do wish they'd made it a simple number if they're going to freeze it for years. We'll see. So, but yeah, that's the figure that's going to be the maximum figure. However, there is a caveat on that, unless it's protected. So if you've got clients that hold protection at the moment, though they won't need the protection to avoid a lifetime allowance charge in the future, they may still need that protection in order to have access to a higher tax-free amount. So, don't tear up those protection certificates just yet. We're waiting for the details on that. In terms of people with enhanced or fixed protection and making contributions, it does appear that people will be able to make contributions because they won't need to rely on those protections anymore, and they will be able to make contributions without affecting the extra tax-free cash they may be able to take. However, I will say, you know, that's only for people that have already got the protections in place, and it'll only apply if they make contributions after 6th of April 23. So don't make contributions this tax year for those people, and, you know, really hold off doing anything until we've seen, you know, the legislation and exactly what's involved on that. But, you know, holding off for those people that won't have contributed for a number of years anyway. The other bit of good news for them is, of course, once they can contribute, they're going to be able to put in more, because the annual allowances are all going up from the 6th of April as well. So the main annual allowance going from 40,000 to 60,000. The money purchase annual allowance is going back to its original level of £10,000. So it's been down at 4,000 for the last few years. You've probably seen in the press there's been lots of action from the industry, really pressuring particularly on the MPAA, that the 4,000 was too low. So it's good to see that's gone up to a more sensible level of £10,000. We also have changes to the tapered annual allowance. So the minimum level for anybody that's tapered will be £10,000. So that's up from the current 4,000. And the threshold where tapering kicks in is going up by 20,000. So you have to have adjusted income above £260,000 to be impacted by the taper, and to have the maximum taper applying. So your tapered annual allowance would be 10,000. Then you'd have to have income in the year, adjusted income in the year of above 360,000. So that's, you know, quite a noticeable increase as well. So yeah, basically, you know, it looks like, you know, great news for pensions. You know, you can all put more, everybody can put more money in, and, you know, not having to worry about the lifetime allowance going forward. Going back a little bit in time, back to the autumn statement, obviously the news we had then was all about freezing of allowances. So these are all, you know, going to be happening from next tax year. So we're going to have a freeze on the personal allowance, the basic rate band for income tax, higher rate band for income tax. I should say all of that applies unless you're in Scotland, because we have different rates in Scotland for anybody north of the border, any clients who are resident north of the border. NI bands, again, NI bands for the whole of the UK are frozen. If you're not in Scotland, they are now aligned as well. The main employee thresholds for NI are aligned with the tax bands. Personal allowance and the high rate thresholds, they're aligned, the NI bands are aligned. So we had a bit of a messy year in terms of NI last year in terms of both bands and rates, but it's all kind of a bit more streamlined now. And inheritance tax has obviously been frozen for, the thresholds have been frozen for a number of years as well. And we know that all of those are going to be frozen until 5th of April 2028. So, you know, we've had good news in terms of pensions, what you can put into pensions. Obviously, this is all in real terms. Tax means we're all going to be paying more tax because these thresholds are all being frozen. In real terms, that's a cut, especially with wage inflation. You know, people are going to be moving up the tax bands as earnings increase. If these bands are frozen, everyone's going to be paying more tax as they go up the bands. Other cuts we had in the autumn statement was the dividend allowance, big one, going from 2,000 2022-23 down to 1,000 next tax year, and then cut again to £500 the following year. Similarly, we have the CGT annual exempt amount being slashed from 12,300 currently down to 6,000 next tax year and 3,000 the year after. So, you know, all of this is, you know, incentives, you know, even more reason than ever to get money into tax wrappers. And obviously with the increase in the allowances for pensions, they've just given us more opportunity to get more money into pensions, and there's even more incentive to do this to avoid paying CGT and dividend tax on here. The other cut we had was on the additional rate threshold for income tax. So currently it kicks in the 45% rate at £150,000. That's going to go down to 125,140 from the 6th of April. Bit of an odd number, but of course that aligns with when it's like the end point for losing your personal allowance. So from 23-24 onwards, whilst all these thresholds are frozen, these are the effective rates of income tax we are going to see. And I say this, apologies to those of you north of the border, so it's a more complicated system in Scotland, but for the rest of us, this is what it looks like. So your personal allowance up to 12,570 tax free. You've then got a basic rate band at 40%, followed by, when you get to 100,000, effective rate of income tax is going to be £60,000. So that's because you have £40,000 higher rate tax plus the removal of the personal allowance. As soon as the removal of the personal allowance is sort of finished with at the 125,140, the tax rate then goes on to the 45% rate above that level. So we can see these earnings between 100,000 and 125,140 is where you effectively pay the highest rate of income tax. And you're going to see, more and more clients who will be tipping over that £100,000 point. With wage inflation, there may be people that are under that level at the moment who might be going over it for the first time. So really, it's worth, I think, a quick reminder of how pension contributions can really help with this and how you can get back that personal allowance. So if I take the example of somebody who's got £125,000 of income, at that rate, if they don't make any pension contributions, they will lose nearly all of their personal allowance. They'll just have £70 left on it there. We can see they have the full basic rate band of 37,700, and the rest of their income falls into the 40% tax band because they've not tipped over into that additional rate band yet. So the total tax bill for the year works out as 42,432. If that same individual were then going to make a pension contribution, if they made a £20,000 net personal contribution, so basically pay that into their pension, get relief at source at 20% on it, so that goes into £25,000 gross, that would give them back all of their personal allowance. So they have 12,570 tax free. They still have the the basic rate band of 37,700. But that basic rate band is actually extended by the amount of the pension contributions, the gross amount of the pension contribution. So there's another 25,000 that falls into that basic rate band, and then just the excess after that goes into the 40% band. So you work out the tax bill at the end of the year when they're doing a self-assessment, and their tax bill now is £32,432. So they've just saved £10,000 there. Plus, of course, they've had the £5,000 tax relief within the pension. So actually, it saves a total of £15,000, and they get the 60% tax relief. Another sort of quick point on this for people who are in this bracket, people who are just tipping over the £100,000, seeing the pension contribution could be very valuable in terms of tax relief, but also if they have children, at the moment, if you have a 3 or 4-year-old, you get 30 hours free childcare. If both parents are in work, or if it's a single parent and they're working, then you get those 30 hours free childcare for children in that age group. The moment you earn over £100,000, you lose it completely. So £99,000 earner, you can have 30 hours free childcare. As soon as you tip over and earn £100,001, you lose it completely. It's not tapered, it's not gradual, it's just gone. So actually, if you think about the cost of childcare, 30 hours childcare, your tax relief in effect is much higher than the 60% you get, because if you make that pension contribution, income comes back down below 100,000, you still get those 30 hours. Now, going forward, this is going to impact even more people, because we also had in the budget the announcement about the extension of the 30 hours free childcare. So it's going to be happening gradually over the next couple of years. It's going to go down to 2-year-olds, and then it's going to go all the way down to somebody that has a 9-month-old child, so starting at the end of maternity leave. It's actually maternity leave. So yeah, it's going all the way down there. So you can definitely see situations, you know, where people can easily have 2 children in there, you know, normal sort of, there's a fairly average age gap for children, you know, 2 or 3 years apart. You could have a, you could have a, you know, a 1-year-old and a 3 or a 4-year-old. So, you know, potentially the 60 hours between the children. That's even, you know, not accounting for people who have twins or anything like that. It would be increasingly common. So you can really see how valuable that pension contribution could be, just to nudge people back below the 100,000 in terms of income tax relief on the pension contribution, but also on their childcare as well. Going sort of back to the CGT cuts, mentioned about that, just a reminder, obviously using BED and ISA. So if you are sitting on gains, crystallise up to the CGT allowance this year and get it into an ISA. Now we're probably very close to tax year end when you're watching this, but also you haven't done that already, but don't forget, you can just do it again at the start of the tax year as well, because though obviously it's been slashed from the 22-23 tax year into 23-24, it gets slashed again the year after. So make sure, you know, you do it again next year. It's still better than the year after that. Spousal transfers, so you can transfer without any gain between between spouses or civil partners, and if you do that, then you can make sure you use both people's allowances. You can also offset any losses made. So if you have had a loss on disposal of assets, then you have 4 years in which to claim that loss and offset it against your gains after the tax year you disposed of the asset in question that made the loss. And then the other thing, sort of planning around CGT cuts, obviously, is the use of offshore bonds, which I'm not going to say more about because you should have just heard from Canada Life, who've talked all about that. Few other things we had from the autumn statement going in the other direction. Moving up, we had confirmation on state pension going up. We also had confirmation that child benefit is going up, like a lot of the benefits related to inflation. So it's just over 10%. September CPI figure, it is going up by. Why am I talking about that? Well, I just want to touch on really the high income child benefit charge, because this is you know, a significant issue and a growing issue as well, that we're seeing people being impacted by the high income child benefit charge. And again, you know, you'll have people who are moving up with wage inflation that, you know, weren't currently impacted by this, who then become impacted by it. Also, we're finding people that are getting impacted by the high income child benefit charge that didn't realise, you know, that it covered them. So high income child benefit charge applies if an individual or their partner is in receipt of child benefit and either of them have income above £50,000. And if they both exceeded, the highest earner is the person who pays it. One thing that probably people don't always realise, it doesn't have to be your own child. If they live under the same roof as you, so for example, if you had a client and they moved in with a partner who has a child from a previous relationship, they don't have parental responsibility for them, but if they are under the same roof and their parent is claiming high income child benefit, claiming child benefit charge, and then your client earns over £50,000, they will be liable for this charge. Say even though it's not their child, even if it's not their child. The way it works, the charge is every £100 earned in excess of £50,000, the tax charge increases by 1%. So it means that if you earn over £60,000, the tax charge is 100%. So it's 100% of however much child benefit you get. You can opt out of child benefit, but if you do that, then NI credits are lost. So it's really important, especially, you know, if there is usually mum, but, you know, not necessarily, who's staying at home and looking after the child, they get NI credits, obviously, which help towards their state pension and other benefits. whilst they're claiming child benefit, whereas if you don't claim it at all, they don't get that. So really important that people do claim child benefit. Now, if you have a client who's becoming a parent for the first time, their earnings are above £60,000, do still fill in the forms. Make sure they still get on the system, so there's no loss of NI credits. Child will also automatically get their NI number at 16, makes it easier for them as well. But there is a box now on that form so you claim child benefit, but you tick a box and say, don't actually pay it to me. Then you don't have to worry about these tax charges. The thing, obviously, for people that are just over it or just tipping over it is to consider pension contributions. So if I have an example for somebody who earns £60,000, has got 2 children, child benefit this year is 1,885, going to 2,075 in 23-24. Work out the income tax for the year, work out the child benefit charge, the high income child benefit charge. That would be 100% of the amount if you earn 60,000, because you lose it all. Got your tax bill there for the year. Alternatively, if you make a 10,000 personal contribution, so that would be an £8,000 net, 10,000 goes into the pension with the tax relief. Income tax bill for the year then comes down to £7,486, and you have no high income child benefit charge. So that 10,000 contribution saves 5,831 tax this year, going to £6,021 next year. So it's more than 60% tax relief on this. So that's actually a higher rate of tax relief than those people with the personal allowance issues. And because child benefit goes up annually with inflation, and the £50,000 limit where the high income child benefit charge kicks in has never changed since it was introduced. If it carries on like that, the difference is going to get bigger every year. So the savings you can make in terms of making pension contributions are going to get bigger every year as well. So just to summarise then on the tax position, basically nearly all of us are going to be paying more tax in 23-24 because of the freezing of the bands. But using pension contributions can help mitigate some of these increases. And with the budget announcements, there's so much more that can be put in. The iron allowances going up, and people that previously couldn't pay in with some of the protections might be able to pay in after 6th of April, and not having to worry about the lifetime allowance as well. Particular pinch points, with the child benefit charge and the loss of the personal allowance, where contributions can be even more valuable, and especially with the childcare element if you do have parents who are tipping over that £100,000 mark as well. Okay, so moving away from tax and tax issues, let's have a look at what the FCA are up to. Consumer duty, obviously, is the biggest thing that's on the FCA agenda. So we have this timeline, which some of you may have seen. I've used this before. We had all the final information, documents, rules back in July last year. First deadline has passed, so larger firms had to submit our plans to the FCA. So we were one of those. We did that back in October. Next deadline we've got approaching is the 30th of April. So this is where we as manufacturers, as we are in consumer duty world, we have to share key information with you as advisors, our distributors of our products, by the 30th of April. So in order for you and us both to be able to implement the duty by 31st of July. There is a second deadline, a year, 12 months further on for closed book products. That doesn't affect us because we don't have any closed book products, but it may impact you because you may have clients who are in closed book products. So that's the sort of timeline that we have. So the first part of that was the plans going to the board on the 31st of October last year. The FCA, based on that, have had a review, basically, on the larger firms with dedicated FCA supervision teams about their plans, seeing what they're happy, what they're not happy with. The feedback from that was ours was fine. They were very happy with what we were doing. They did have some concerns with some firms. One of the areas in particular was that they hadn't appointed somebody senior enough to be the consumer duty champion, or they were just saying the responsibility fell on the whole board rather than on an individual, and basically they made it clear they're not happy with that. That's not their intention. That's not what they want firms to do. They also said that in the next few weeks, when this was the end of January, so kind of put it past that a bit now. The survey was going to be sent to 600 small, medium-sized firms. So some of you may have had that, which is basically the sort of the next stage, because the first bit was just larger firms, smaller firms, to get an idea of what small and medium-sized firms are doing to implement the consumer duty as well. So this review they've done based on sort of the first stage, they've come back and said there's 3 key areas they want firms to focus their attention on. The first one they've said is about effective prioritisation. So this is about focusing on areas that's going to make the biggest impact on outcomes for your customers, consumers on that. The second one is about embedding substantive requirements. So about making sure changes needed, you make the changes needed so customers, your consumers, clients receive the communications that they understand, that the products and services that they are taking up meet their needs of fair value. And also there's a big bit there about customer support, making sure people get what they need, not just part of the sales process, but after sales, vulnerable customers all comes under that as well. And then the last one they said is about working with other firms. So this is about, working closely with your commercial partners, making sure, we all deliver good customer outcomes. There's a chain, a consumer duty chain, isn't there? You've got investments, on a platform in a SIP wrapper. So, you've got the fund managers are in there. There's us as a SIP provider, there's you as advisors, and, there's a whole chain there, for the clients. So making sure we all work together. So, sort of as part of that, I suppose my question for you is, what we can do to help you. So, we have a deadline, let's say 30th of April, for us to share information with you. We are planning to share price value assessment information, information on products and services, target market information, to help you meet your consumer duty. But this was the question, is there anything else that you want from us? And if there is, then, please do let us know what else we can do to help you meet your consumer duty. Moving on, FCA have also said they are going to conduct thematic review of retirement income advice. This review is beginning Q1 this year, so kicking off now, with the aim of publishing their findings before the end of the year. Firms, I'm guessing now, because they said this in January, that firms selected for the review can expect to be contacted early in 2023, so they probably will have contacted most of them by now. But the results of this will be sort of an indicator of how firms are implementing consumer duty in this area. So one to watch out for. Pensions dashboards, I talked a bit about this when I was out on the road. We've had a lot more updates from the FCA, DWP, pensions dashboard plan, lots of things like this. We had a deadline for connecting to the dashboard of 31st of August 23. However, it was announced by the Pensions Minister that it is all now on hold. So there's been a few issues with the pension desk programme, the testing and things not going as smoothly maybe as hoped. So we're keen to stress that it's still going to happen, it's still going on, we should still be preparing for it. But in terms of the timeline, we're waiting to see the revised schedule on this. So when I say on hold, I suppose it is kind of on hold, but we are still doing work on this, and it is still coming, it is still preparing for it. A few other bits and pieces. We had out from the FCA at the end of last year this paper on non-workplace pensions, which was just sort of long awaited. There's 2 main things in this paper. First one doesn't really impact advisors, but just so you're aware of it, from 1st of December next year, 1st of December this year, 2023, we will have to offer default option, investment option to non-advised customers in non-workplace pensions. Somebody joining our SIP will have to be offered a default, even on the non-advised side of things. It's not like auto-enrolment where, if you do nothing, you end up in that fund, because they still have to actually say, yes, please, I'll have the default, but we have to offer it prominently, a ready-made standardized investment solution on that. you don't have to discount it before recommending other investments in the same way you should do with investment pathways. So it's fairly straightforward for you. But the other part of this, which does affect clients whether advised or not, is about cash warnings. So we, pension providers, will have to issue cash warnings to any customer with significant sustained levels of cash in their non-workplace pension. So this applies to all customers, takes place every 3 months. We have to assess it, and those who are caught with, they have £10,000 or more in cash, and that is more than 25% of their fund, then we will have to issue cash warnings, and we will have to send those directly to clients. Obviously we will tell you when we're doing it, but we do have to send them directly to them. So again, that's 1st of December that comes in. Last little one from FCA is on the future disclosure framework. So a discussion paper came out at the end of last year. This is all it's all related to Brexit, basically, because we don't have to follow the EU rules anymore. So we're looking at this afresh. So this is disclosure, very wide ranging, sort of not just, you know, illustrations, you know, key features, kids, you know, all disclosure products, looking at views on how we deliver disclosure, the presentation of it and the content, what goes in on that. This consultation will, sorry, this isn't a consultation, this is a discussion paper. A consultation paper will follow probably in the next few months on that. And then after that, you know, we will get, you know, policy statement and changes coming. So it is the very early stages, but yeah, it looks like changes to disclosure are coming. Finally, I'm going to wrap up with a little bit of industry news. So we had a few bits and pieces out from the DWP at the end of January. First thing was around value for money. Now, this is actually a joint piece of work from DWP, FCA and TPR, and it relates initially just to workplace pensions, but the FCA have said that they will consider, you know, basically their intention is to expand this at a later date to non-workplace pensions as well, including SIPs, including pensions and decumulation. So probably not a direct impact for us just now, but it is coming. Obviously, you will have clients that may be impacted in workplace pensions elsewhere. So for value for money, they're looking at doing a framework with a RAG system which will look at investment performance, costs and charges, and quality of service. They'll get a RAG rating. Depending on those ratings, you know, certain action will have to be taken by the trustees on that. So this is a consultation. Deadline is 27th of March. It turns exactly when you're watching this, whether it'll have closed or just about to close on that one. The other one they released same day with the same deadline is about collective defined contribution pension schemes. So at the moment, I think the only one up there is this Royal Mail scheme, but they are looking at the possibility of having multi-employer CDC schemes available. So we're looking at that. And then the last one they've got is about small pots. So this is a call for evidence. So again, early stage of the consultation process. But small pots isn't anything that we haven't looked at many times before, I think. So the two main proposals in this are, one is around pot full of member, and the other one is about having auto consolidation, you know, so where pots are below a certain size are auto consolidated into these, you know, big providers that are selected for these purposes. So there's questions in there about, you know, what's the appropriate size of pot is for that to happen. As I say, I'm not sure. You know, it still really deals with the issues, you know, of protection, you know, people transfer, or just, you know, people transferring automatically being consolidated into a product which then has higher charges and things like that. Yeah, that's all out there as well. One thing which was mooted, but we didn't hear anything of in the budget, was about the increase to state pension age. So there were reports out in January saying that was going to be in the budget. They were going to bring forward the increase to age 68. Obviously, we didn't have anything on that. But, you know, we are still due. This review has to come out by May. It's due, the state pension age review. We know it will be going to 68, age 68 at the moment. It's, you know, planned not to happen until the 2040s. But, you know, the reports were whether it's going to be brought early. I'm sort of cautiously optimistic because we haven't heard anything that they might not do anything with that. But, you know, obviously we'll have to wait and see till the review say comes out. Obviously, we know when other people have tried to change state pension age, what's happened with our friends across the channel. That's only going to 64, and that's not going very smoothly for them there. So we'll wait and see on that one. Final bits and pieces I'm going to talk about, just a few bits from the IFS. The Institute for Fiscal Studies are a think tank. So they're not government, they don't make policy, but they are in the ears of government and have some influence. They had a few papers out recently. They've been very active in the pension space. Just before Christmas, they had this first report on death and taxes and pensions, basically saying that the tax treatment of pensions on death is far too generous, and the system basically encourages people to use it for passing on funds down the generations, you know, and not use it for pension. You know, I'm sure you've all had conversations with wealthy clients and basically on the lines of use everything else first, touch your pension last, because it's outside the estate, pass it on. And I think the changes in the budget in terms of the removal of the lifetime allowance is only going to encourage that, plus your increases in annual allowance is only going to encourage it even more. You know, it kind of goes against what the IFS were saying and wanting to do. So what the IFS were proposing in this is that there should be an income tax charge on all funds that remain in the pension on death. So none of this, if you die before 75, it's tax-free. You'll be taxed for everybody, any beneficiary, as income tax. I think that would be relatively easy to bring in, and probably not too controversial, really. But the second part was that they should bring pension pots within a deceased estate for the purposes of inheritance tax, which obviously would be a lot more controversial. And you know, can't see massive changes given the fact we've just had the budget coming in any time soon. But you know, certainly if we had a different government, you know, they have very different views on these things. And I know they've already talked about saying they would want to reverse the abolishment of the lifetime allowance, but in practice that might be quite difficult to do. Whereas this, yeah, we'll see anyway on that one. Other one from the IFS was a sort of a wider piece on better tax treatment of pensions. So there's a lot of proposals here on tax relief, how tax relief works. So in the past, we've had lots of rumours about flat rate relief. You know, 30% is often the rate that's been quoted, but having a flat rate relief doesn't work. You know, they acknowledge that in this report. There's lots of issues because, you know, you just have employer contributions, how it works with DB schemes. So they have come up with a different proposal, which is about having basically the equivalent of NI relief on personal contributions, because that would benefit people on lower incomes more. Because, you know, if you're taking your top slice of income and putting it into your pension, if you are a basic rate taxpayer, you're paying NI 12% on that, whereas if you're a higher rate taxpayer, you're only paying 1%. So the relief helps those on lower income rather than those on higher income. It also talks about removing NI relief for employers completely. So it would help you. Employers would pay NI on pension contributions in the same way they do on salary, but replacing it with a subsidy instead. So employers wouldn't be worse off, but it would be more evenly spread. Because at the moment, obviously, there are some employees where the employer doesn't pay NI, so you sort of get rid of that element on it. But the flip side of this would be that you would pay national insurance on pension income. So that's quite an interesting idea because it's something quite different to any sort of proposals we've seen before, which you can see sort of, you know, some kind of reasons, sort of logic behind that. But it's a big change. You'd hope they would do consultation on that before anything came in, if they were ever going to do anything like that. In the paper, they also talked about increasing the lifetime allowance. Well, we know what's happened with that. They talked about putting a cap on PCLS. They were talking about making it quite a lot lower than the cap we know is coming in now. They were talking about 25% of 400k, so a 100k cap. Yeah, I'm not sure, given the changes we've just had, how likely we're going to see that anytime soon. Final thing I'm going to mention from the IFS is a much bigger piece of work they're doing. Obviously, they've had the few papers recently, but this they've announced this, they're going to do this pension review. So this is a big 2.5-year project to comprehensively assess, you know, the consequences of current pension policy, look at the economic environment, and look at the individual behaviour and, you know, what it means for the future of living standards in retirement. This is intended to provide recommendations for reform to improve outcomes for future generations of pensioners. 3 sort of key questions they're going to look at and explore in depth. You know, are people saving enough for retirement in terms of both the amount and form of savings? If they're not doing that, how can government policies help? You know, looking at how the state should support people from later working life into retirement, and you know, whether people need more assistance to use their wealth appropriately through retirement. So review is going to be launched April 23, so imminently. First findings are expected to come out sort of autumn this year, and then the main report, the key findings and all the recommendations are due sort of summer 2024. So you know, that's a big picture stuff, looking at all that, you know, which may, you know, shape future government policy. We shall see. But that is all for my roundup for today. I do hope that's been useful, and as I say, we do intend doing another more in-depth bit on the budget changes relating to pensions, so look out for that one. But thank you.
Thank you very much for joining us today. Hope you enjoyed the session. Just a quick reminder, you'll have your feedback forms coming up just after the session. If you complete those, any feedback for the speakers of the session would be excellent. Any questions you've entered during the chat will be answered in due course, and you should be receiving your CPD certificates and a copy of the slides very shortly after the session. So thank you again for joining us, and take care.